Good morning, everybody. In recent years, this subcommittee has devoted significant time and effort to exposing complex financial arrangements that profitable corporations and wealthy individuals employ to avoid their obligations to pay all their U.S. taxes. We also have examined reckless behavior that has put the stability of the financial system and, by extension, the U.S. economy at risk. Today's hearing brings those two themes together. Our focus today is on how two banks and a handful of hedge funds developed a complex financial structure to engage in highly profitable trades while claiming an unjustified lower tax rate and avoiding limits on trading with borrowed money. This structure worked well for the banks, which earned hundreds of millions of dollars in fees. It worked well for the hedge funds, which made billions of dollars in profits. But it didn't work for average taxpayers, who had to shoulder the tax burden that these hedge funds shrugged off with the aid of the banks. And it didn't work for the financial system, which is still recovering from a devastating crisis brought on by excess risk and remains ill-equipped to withstand another shock from over-leveraged financial institutions. In essence, today's hearing is about a series of fictions, one piled on top of another, fictions that major banks and their hedge fund clients use to avoid taxes and federal leverage limits. The key financial product involved in these fictions is called a basket option. The basket options examined by the subcommittee were developed and sold by two banks, Deutsche Bank AG and Barclays Bank PLC, to more than a dozen hedge funds. Together, the banks sold 199 basket options to hedge funds that used them to make over $100 billion in trades. Two of the largest basket option users were Renaissance Technologies, known as Rentech, and George Weiss Associates. Although there were minor differences in specifics, the basket option basics worked like this. The bank sold its hedge fund client a structured financial product called an option, whose payoff equaled the profits generated by a basket of securities held in a designated account at the bank. The basket here is key. It was an open account with ever-changing contents. Technically, the account and the securities it contained were held in the name of the banks in its own trading account. The hedge fund put up 10% of the cash needed to buy the securities, and the bank lent the other 90%. This arrangement included a number of fictions which defied reality, but resulted in big profits for the hedge funds and the banks. First, though the structure was designed to create the appearance that the bank owned the assets in the basket option account, the hedge fund made all the trading decisions for those accounts and, in fact, used the bank's computerized trading system to execute trades in the account. Rentech estimates that its trading through basket option accounts averaged more than 100,000 trades each day, or about 30 million trades a year. Also, the hedge fund reaped all the trading profits, even though the financial structure created the illusion that the bank owned the assets. The beneficial owner, the real owner, was the hedge fund. Now, second, the hedge fund's control of all the trading for basket option account demolishes the fiction of a legitimate option. So the hedge fund set up new entities which they controlled to serve one function, and that was to act as the option holder. The hedge funds would then claim that their control of the option holder was totally independent of their role in making the trading decisions for the basket option account. Documents that we'll explore today show the extraordinary lengths to which Rentech and the banks went to perpetuate the illusion that the option holder and trader were somehow independent, when in fact the hedge fund, Rentech, played both roles. The fictional option was structured so that it could be exercised more than 1 year after it was created. Under that structure, the hedge funds claimed that trading profits from the account were long-term capital gains and thereby qualified for the reduced long-term capital gains tax rate. The tax code gives long-term capital gains a reduced rate on the theory that it provides an incentive for investors to risk their capital on the kind of long-term investments that grow the economy and create jobs. The high-volume trading that, for example, Rentech conducted through its basket options doesn't meet that test. When securities are held for weeks or days or even seconds, it's surreal to characterize those trading profits as long-term capital gains. But that's what the hedge funds did. The banks and hedge funds used the fictional option structure to collapse millions of individual trades into one transaction, the execution of an option. As if by magic, the option structure transformed what would be short-term capital gains from an ordinary trading account into long-term capital gains subject to lower taxes. Subcommittee staff estimates, based on basket option profits that Rentech reports from 2000 to 2013, that Rentech avoided paying more than $6 billion in taxes that way. Now, that's a lot of money even by Washington standards. It would, for example, pay for almost 2/3 of the cost to replenish the highway trust fund so that it doesn't run out of money next month and create havoc in road projects around the country. This isn't the first time options have been abused to try to convert short-term trading profits into long-term capital gains. And that's why in 1999, Congress passed a law to, in part, stop that practice. And that's Section 1260 of the tax code. The basket options at issue here were written to skirt Section 1260's prohibition. But in 2010, the IRS warned that the type of basket options used here could not claim the lower long-term capital gains tax rate. Despite that IRS warning, Barclays continued to sell basket options to Rentech for another 2 years before finally revising its option product in 2013 so that the options expired in less than a year and couldn't be used to game the tax code. Deutsche Bank suspended its issuance of new basket options after the 2010 IRS warning, but continued to administer multiple basket option accounts already in existence. It also resumed offering them in 2012, although with a term of less than 1 year and a requirement that the option holder treat the profits as short-term capital gains. Tax avoidance through financial engineering is not the only problematic element here. These banks and hedge funds also use basket option accounts to circumvent regulations designed to limit systemic risks to the banking system posed by excessive leverage, and that is excessive lending to finance stock trading. The stock market crash of 1929 devastated the U.S. economy, not just by the collapse of thousands of stock speculators, but also by the failure of thousands of banks that had lent them money and couldn't collect on the loans. In the aftermath of the Great Depression, Congress enacted laws limiting the use of borrowed money to trade securities. Those limits are included in a set of margin rules that essentially prohibit U.S. broker-dealers from lending more than $1 to brokerage clients for each dollar of the client's own money in the account. In other words, for every $2 in a brokerage account, only $1 of that $2 can be borrowed from the broker. Had the hedge funds involved in these transactions been using normal brokerage accounts, they would have been subject to the 2-to-1 leverage limit. But because the basket option accounts were opened in the name of the banks in their own proprietary trading accounts, it looked as though the money placed in those accounts was the bank's own proprietary money rather than the money they were loaning to a customer. And this is another fiction. The banks and hedge funds pretended the bank funds were not loans, even though the hedge funds paid financing fees and posted collateral. So instead of complying with the 2-to-1 leverage ratio, the banks offered their hedge fund clients leverage as high as 20-to-1. Rentech used the increased leverage to borrow billions of dollars for its trading strategies, which produced huge profits for Rentech, while the lending generated huge additional fees for the banks. But as we've learned over and over, in the Depression, in the 1990s collapse of the hedge fund called long-term capital management, and in the financial crisis from which we're still recovering, excessive leverage doesn't always produce profits. Sometimes it produces losses. And when huge losses happen, they can bring down not just a reckless borrower, but the financial institution that lent it money, and that failure can ripple through the entire financial system. While it appears the two banks the subcommittee has examined have stopped selling basket options as a way to claim long-term capital gains rates, they are still selling these products as a way to avoid leverage limits, meaning our financial system and economy still face unnecessary risk. Rentech, through its Medallion funds, used basket options to produce profits from 1999 to 2013, totaling more than $30 billion. The banks charged financing, trading, and other fees that over the same period produced revenues totaling about $570 million for Deutsche Bank and $655 million for Barclays. Basket options were clearly a lucrative line of business for the participants. But this moneymaker was built on an interlocking series of fictions. The key fiction is the option itself. The idea that this structure was really an option when in fact what it did was give hedge funds the profits from buying and selling assets and accounts that the hedge funds themselves controlled. It was fiction to treat the bank as the true owners of the basket option assets when the hedge funds controlled and executed all of the millions of trades in the accounts, when the hedge funds paid the daily trading costs, and when the hedge funds reaped the profits. It was fiction to suggest that the borrowed money that financed the trades was considered proprietary funds of the banks rather than loans to the hedge funds. It was fiction to treat the profits from trades lasting days or even seconds as long-term capital gains deserving a reduced tax rate. And it was a fiction to pretend that hedge funds were not acting both as option holder and trade decision maker. These were all fictions, but fictions with real-world consequences. They shifted billions of dollars in tax burden onto the backs of ordinary taxpayers, and they added billions of dollars in hidden risks to our financial system. Congress and financial regulators can and should work together to stop these abuses. The IRS should seek to collect taxes owed on billions of dollars in basket option profits unjustifiably claimed as long-term capital gains. Federal financial regulators should make clear to banks that participating in abusive structures designed to avoid leverage limits and taxes is unacceptable and penalize the banks that do. The Financial Stability Oversight Council, working with other agencies, should establish reporting and data collection requirements to detect and to stop abuse of structured financial products to circumvent leverage limits that safeguard our economy. And finally, Treasury and the IRS should remove impediments to audits of large partnerships like hedge funds, 99% of which today escape IRS audits, meaning that we're largely blind to how many other hedge funds may be using structures of this type to avoid risk limits and taxes. These measures would help protect the interests of ordinary Americans who pay their taxes and who must pay the price for tax avoidance schemes. It is these same Americans who would bear the burden of economic devastation that unaddressed systemic risks can cause. I want to thank Senator McCain and his staff for their hard work in making today's hearing and our bipartisan report possible. The staff of this subcommittee, majority and minority, through the years, have been able to work together as one team, and I am very proud of them. Senator McCain.
Well, thank you, Mr. Chairman. And one of the aspects of my term and tour here in the United States Senate is the relationship that you and I have developed over many years and the work we do together. I think people of Michigan and Arizona and the country are better off for it. I thank you for today's hearing, and today's hearing sheds light on how Renaissance Technologies was able to avoid paying more than $6 billion in taxes by disguising its day-to-day stock trades as long-term investments. To accomplish that, Renaissance set up a, quote, basket option, which is an artificial structure not available to ordinary consumers that allowed Renaissance to legally classify its short-term trading profits as long-term capital gains, subjecting those gains to a substantially lower tax rate. Renaissance profited from this tax treatment by insisting on the fiction that it didn't really own the stocks it traded, that the banks that Renaissance dealt with did. But the fact is that Renaissance did all the trading, maintained full control over the account, bore all the real risk, and reaped all of its profits. This setup allowed Renaissance to claim that profits from its day-to-day trades were actually long-term investments, thereby avoiding payment of billions of dollars in taxes. In reaction to Renaissance's use of this structure, the IRS opened an investigation and today is in the process of litigating the legal issues. It's not the subcommittee's place to weigh in on those proceedings and determine whether the behavior in question was illegal. But this basket option practice, available to hedge funds but inaccessible to the average investor, needs to be fully examined and addressed. The biggest reason why it should be examined is the tremendous amount of taxes Renaissance was able to avoid paying by using this structure. In the course of its investigation, the subcommittee learned that between the years 2000 and 2014, Renaissance exercised 60 long-term basket options with Deutsche Bank and Barclays, earning in the neighborhood of $34 billion in pre-tax profits and potentially avoiding over $6 billion in taxes. Mr. Chairman, those are very large amounts of money. Meanwhile, Deutsche Bank and Barclays happily took part in the basket options because they made hundreds of millions of dollars in fees from these transactions while incurring no actual risk. That is, until the IRS started to investigate. To protect themselves, Deutsche Bank in 2010 and Barclays in 2012 decided to only offer Renaissance options lasting less than 1 year so that all the profits from the options would have to be considered short-term capital gains. Large trading firms will always try to stay one step ahead of the game when it comes to pushing the envelope on the tax code to minimize paying taxes, and regulators will inevitably struggle to detect and stop new schemes as they arise. It's therefore critical that regulators use the resources they have in an efficient manner to target the most likely offenders. So whatever practical impediments currently disable the IRS from auditing large partnerships that use these sort of tax structures should be eased or eliminated. Doing so would allow the IRS to audit companies based on a careful assessment of the likelihood that a given company is engaging in activities that warrant an audit. This would differ from the current practice, which focuses on the corporate form selected by that company, which has led to corporations being disproportionately audited. One thing is clear. Americans are tired of seeing Wall Street firms playing by a set of rules other than those that apply to ordinary citizens. Even as consumers worried about losing their savings in the 2008 financial crisis, Renaissance remained enormously profitable throughout by, among other things, utilizing the tax avoidance structure detailed in today's hearing. When ordinary citizens make short-term trades, they get taxed at the short-term rate. When financial firms like Renaissance make short-term trades, they shouldn't be treated any differently. The perception that Wall Street self-deals or plays by its own rules engenders a deep-seated distrust and cynicism among Americans that is neither desirable nor healthy for the nation. I want to thank the witnesses for appearing before the subcommittee today, and I look forward to their testimony. Thank you, Mr. Chairman.
Thank you very much, Senator McCain. I'd like to now call our first panel of witnesses for this morning's hearing, Stephen Rosenthal, a senior fellow at the Urban Brookings Tax Policy Center, and James R. White, the Director of Tax Issues at the U.S. Government Accountability Office, the GAO. I appreciate both of you being with us this morning. We look forward to your testimony pursuant to our Rule 6. All witnesses who testify before the subcommittee are required to be sworn, so I would ask both of you to please stand and raise your right hand. Do you swear that the testimony you're about to give before this subcommittee will be the truth, the whole truth, and nothing but the truth, so help you God? Our timing system today will work as follows. 1 minute before the red light comes on, you'll see the lights change from green to yellow, giving you an opportunity to conclude your remarks. Your written testimony will be printed in the record in its entirety. We would appreciate your trying to limit your oral testimony to 7 minutes. And Mr. Rosenthal will have you go first, followed by Mr. White, and then we'll turn to questions. Mr. Rosenthal.
Thank you, Mr. Chairman, Ranking Member McCain, and the subcommittee for the opportunity to testify on the abuse of structured financial products. My name is Steve Rosenthal. I am a senior fellow at the Urban Brookings Tax Policy Center. I am presenting my own views and not those of the Urban Institute, the Brookings Institution, the Tax Policy Center, or any other person. I have practiced tax law in Washington, D.C. for over 25 years. In private practice, I regularly advised hedge funds and other investors on the tax treatment of derivatives. In the 1990s, I was a legislation counsel with the Joint Committee on Taxation, where I helped draft tax rules for financial institutions, financial products, capital gains, and related areas. Almost a century ago, Congress reduced the tax rates for long-term capital gains. Then, long-term meant holding assets for 2 years. Now it means holding assets for at least 1 year. But for a century, regular tax rates have applied to gains on the sale of assets that have been held for a short term. I have been asked to evaluate the character of the gains of the Renaissance hedge funds based on my review of materials provided by the subcommittee staff. The Renaissance hedge funds traded often, more than 100,000 trades a day, more than 30 million trades a year. And they traded quickly, turning over their portfolio almost completely every 3 months. Because the hedge funds adopted a short-term trading strategy, we would expect their gains to be short-term. But the hedge funds, with the help of Barclays and Deutsche Bank, wrapped derivatives around their trading strategy in order to transform their short-term trading profits into long-term capital gains. This tax alchemy purported to reduce the tax rate on the gains from 35% to 15% and reduce taxes paid to the Treasury by approximately $6.8 billion. I believe the hedge funds stretched the derivatives beyond recognition for tax purposes and mischaracterized their profits as long-term gains. Here's how it worked. The hedge funds did not buy, hold, and sell their stocks directly. Instead, the hedge funds arranged for the banks to buy, hold, and sell the stocks. There were two steps. First, the bank granted the hedge fund's general partner, Renaissance, the exclusive authority to select stocks to buy and sell for an account, when to buy and sell, and how to size and route the orders. Second, the bank agreed to pay the hedge fund the net profits from the trading of the stocks in the account at the bank. I will label this arrangement the basket contract. To fund an account, a hedge fund might deposit, say, $10 million. The bank also might contribute $90 million, which permitted up to $100 million to trade. The basket contract typically had a term of 2 or 3 years, but a hedge fund could demand the bank cash out a basket contract at any time. In fact, the hedge fund typically cashed out the basket contracts after more than a year in order to qualify their profits as long-term. To protect against losses in excess of $10 million, the original deposit, a bank contract would automatically be knocked out, that is liquidated, if the value of the account fell from $100 million to $90 million. But the banks also put in place protections to prevent the account from falling that much. In practice, no basket contract was knocked out, none of the 60. The tax law characterizes an arrangement based on its substance, not its form. In substance, Mr. Chairman, I believe the hedge funds possessed tax ownership of the stock in the accounts. The hedge funds, through their general partner, Renaissance, directed the buying and selling of the stocks, and the hedge funds profited completely from the trading. To establish tax ownership, the party's label of a contract does not matter. For example, the IRS treated a deep-in-the-money option as ownership of the underlying stock. That was because the option was so likely to be exercised, the taxpayer effectively assumed the benefits and burdens of owning the stock. Similarly, I believe the benefits and burdens of the stock basket belong to the hedge funds. First, the hedge funds enjoyed the opportunities of gain from trading the stocks and incurred the burden of losses, at least until the banks stopped the trading. Second, the hedge funds earned the interest, dividends, and other income from the stocks, bonds, and cash in the account, and the hedge funds paid the financing, commissions, and other expenses from the trading. Finally, the hedge funds, through their general partner, Renaissance, selected the stocks to buy and sell for the designated accounts, when to buy and sell them, and how to size and route the orders. As a result, the investment arrangement simply rewarded the hedge funds for their own trading efforts. Moreover, even if the basket contracts were respected, the gains from the basket contracts must be recognized currently. The hedge funds changed the economics of the basket contracts when their agent, Renaissance, traded in the designated account. And modifying a contract materially is a taxable event. The deferral was inappropriate. As a result, I believe the IRS can and should challenge these strategies. But the IRS has limited resources to challenge the wide variety of derivative-related strategies, which often are complicated and abstruse. So in my view, Congress should address the taxation of derivatives comprehensively to reflect the income of derivatives more clearly. I believe the tax accounting for derivatives ought to follow financial accounting, which requires companies to mark to market the derivatives at year end. That is, to report any income from derivatives as ordinary, as if the derivatives were sold at the end of each year. Last year, Chairman Camp of the House Ways and Means Committee proposed to mark-to-market derivatives for tax purposes. I believe this step is overdue. It would greatly reduce the amount of time and energy that taxpayers and the IRS devote to the taxation of derivatives. an enterprise that is demanding far too many efforts in the most recent tax years. Thank you, and I'm happy to take any questions.
Thank you very much, Mr. Rosenthal. Mr. White.
Chairman Levin, Ranking Member McCain, I'm pleased to be here for the hearing on structured financial products. A number of the entities offering these products are large partnerships, which we define as those with over 100 direct and indirect partners and over $100 million in assets. I will describe them and the challenges IRS faces in auditing them. First, some background. Partnerships are pass-through entities that do not pay taxes but instead pass income or losses through to their partners to include on their own tax returns. Partnerships can be partners in other partnerships. That is, partnerships can be tiered, making tracking income through the tiers complicated. The number of partnerships of all sizes is growing, with a big shift towards businesses organized as partnerships and away from corporations. Between 2002 and 2010, the number of all partnerships grew 45% to over 3 million, while the number of corporations liable for the corporate income tax decreased 14% to 1.5 million. Large partnerships grew even faster, tripling to over 10,000. Now I'll describe large partnerships. According to IRS, many of these are investment funds, such as hedge funds or private equity funds. These funds may have hundreds of thousands of investors who are legally partners. When investing, the funds may create other large partnerships. For example, if a fund with 1 million partners invests in a small operating partnership, say in oil and gas, then the oil and gas partnership would now be large. The original direct oil and gas partners would be joined by 1 million indirect partners. Figure 2 on page 6 of my statement shows the sizes of large partnerships, with almost 3,000 having more than 10,000 direct and indirect partners. My next point is that IRS audits very few large partnerships and makes few changes when it does. For example, in 2012, the audit rate for large partnerships was 0.8%, less than 1%. For large corporations, the audit rate was 27%, or 33 times higher. The few audits done of large partnerships were not very productive. 2/3 resulted in no change to the partnership's reported income. When adjustments were made, positive and negative changes roughly canceled each other out. Now I turn to IRS's audit challenges, which may explain the low audit rate and poor audit results. Tiers of partnerships create very complex income flows. An example is figure 3 on page 7 of my statement. The audited partnership at the left earns income that passes through 8 other partnerships before reaching the ultimate owner who is responsible for any tax. IRS has the challenge of tracking the income as it flows through the tiers and verifying that the amount and nature of the income is correctly reported. Are capital gains short or long term? Is income passive or non-passive? IRS officials told us they have difficulty in identifying the business purposes of large partnerships and the source of income. And figure 3 is a simple example with only 50 partners and 10 tiers. IRS said some have over 1 million partners and some over 50 tiers. While such complicated business structures can be used for tax evasion, I want to emphasize that they can also have legitimate business purposes, such as isolating one part of a business from the liabilities of another part. In addition to this complexity, IRS auditors said administrative procedures can make it challenging to finish an audit within the 3-year statute of limitations. The Tax Equity and Fiscal Responsibility Act of 1982, or TEFRA, was passed to correct problems with fragmented audits of multiple partners. However, auditors told us that TEFRA can hinder audits of large partnerships. One challenge is identifying the tax managing partner, or TMP, who represents the partnership in an audit. IRS auditors told us that the process can sometimes take months, with some partnerships using this as a delaying tactic to reduce the time available for the actual audit. Another TEFRA challenge is passing audit adjustments through to taxable partners. According to IRS, linking a large partnership to thousands of direct and indirect partners spread over many tiers is extremely burdensome and limits the number of audits that can be done. Furthermore, by the time an audit adjustment is spread over thousands of partners, the amount per partner may be so diluted that it is not worth passing through. To summarize, large partnerships are increasing in number. IRS audits very few and gets poor results when it does audit them. The complexity of both the partnerships and the audit procedures may explain this picture. We are still completing the review requested by this committee and plan to issue a report this fall with more details and, if warranted, recommendations. Mr. Chairman, this ends my statement, and I'd be pleased to respond to questions.
Thank you very much, Mr. White. Mr. Rosenthal, substance over form judicial doctrine permits the IRS to recharacterize a transaction according to its actual substance. The purpose of the doctrine is to prevent a taxpayer from calling a transaction something that it isn't, in order to avoid tax liability. Renaissance has asserted that its characterization of the basket option should be respected for tax purposes and that it should be entitled to long-term capital gains treatment because the basket option they claim was held for more than a year. It is asserted in part that it is entitled to this treatment because the transaction had a business purpose, including the claim that the transaction provided it with more leverage than could be obtained in a margin account. Now, does the claim of Renaissance that it had a business purpose answer the question of whether the structure was properly characterized as an option for tax purpose?
No, in my view, Chairman Levin, I do not believe the mere existence of a business purpose demonstrates conclusively that the labels affixed to the arrangement will be respected by a court of law. The key question in considering economic substance is what is the substance of the arrangement, not merely the form or the labels affixed by the parties to the arrangement. And here, in substance, in my view, the basket of stocks, which was directed by the hedge fund, buy and sells, and controlled by the hedge fund, the benefits and burdens, and the true owner of that basket of stocks, in substance, belonged to the hedge funds.
Now, you've reviewed in your testimony, and I've reviewed in my opening statement what some of those actual facts were that constituted beneficial ownership. Would you agree that the hedge fund was the beneficial owner here?
Yes, I would.
And they received all the dividends from the trades as part of the option profits. They made the profits were theirs. Renaissance executed tens of millions of trades in a year in that account. It was charged a financing fee on the amount that it borrowed for the account. It received the rebates for the orders that it sent to stock exchange. And again, it received all the profits from its trading and was exposed to most of the risk, with the exception of catastrophic risk. And there were even safeguards in the agreements to limit that risk. Now, in connection with the transactions affected by the bank's basket accounts, it retained certain indicia of ownership, such as the legal title, apparently, the right to vote shares. It's kind of hard to imagine voting shares when there's 30 million trades during a year, but nonetheless, that right was retained. The right to lend shares out of their accounts to customers for fees. Now, how significant is it that the banks retained those indicia of ownership for determining who's the beneficial owner of the real transactions and the items that were in the account?
Not very significant in my view, Mr. Chairman. The right to vote a publicly traded stock, a minority interest that was bought and sold within a few weeks, not a long-term holding, in my view, is economically meaningless. The question of ownership is broader than mere form of title. And the courts repeatedly, dozens and dozens of times, have admonished taxpayers that mere semblance of title does not answer the question of true ownership of the property. To determine true ownership, you need to look broadly at benefits and burdens. Who benefited when the stocks went up? Who lost when the stocks went down? And you need to think about who actually receives the beneficial income, the income from the beneficial ownership, of the stocks. And most importantly, you need to think about control and when stocks were bought and when stocks were sold, and who determined that. In practice, I must have reviewed dozens, if not hundreds, of derivatives for a variety of investors. And derivatives, by their nature, derive value from some other asset or some other indice. But there are limits to when a derivative, when an arrangement reflects a derivative, and when an arrangement reflects ownership. And here, the hedge funds simply crashed through those limits. They undertook a direction of what to buy and what to sell. They picked up all expenses, including commissions. They effectively determined what the bank would hold. They purported, I read in the materials provided to me, that the bank had discretion as to whether to follow the directions of the buys and sells or whether to maintain positions. But in 30 million trades a year, over 300 million trades, I didn't hear of a single instance in which the bank simply followed through and recorded ownership of the stock in the account per the direction of the hedge fund acting through Renaissance, its general partner. So the question of ownership is a facts and circumstance question looking at all the facts. But here the key elements of ownership, in my view, point to the hedge fund owning the basket of stocks, not the banks, notwithstanding the nominal title that the banks purported to have of the stocks in the account.
Now, the banks gave Renaissance direct access to the market through their trading execution system so that Renaissance executed the trades as well as receiving the profits and the losses. They had the right under their contracts not to execute. But do you know of any circumstances that through looking through these materials where they did not follow the algorithm which was provided to it?
To my knowledge, the general partner, Renaissance of the hedge fund, would direct trades directly to the exchange. That direction would take milliseconds. There was no, as far as I could see, any practical way for the bank to intervene and stop that order from going to the market. And as a practical matter, there really was very little opportunity for the bank to take a position out of the account and sell it, understanding that the hedge fund might want to sell the position in a matter of weeks. The bank made a lot of fees merely accommodating the hedge funds. I don't think the bank had any interest in independently owning those securities in their account.
Now, at one point, the banks suggest that they were the execution was simply, by Renaissance, was simply a recommendation or a suggestion to the bank. Have you seen any evidence that this was a recommendation or a suggestion?
No, I have not seen any evidence of that.
Is there any practical way in which 30 million trades a year could be 30 million recommendations, well, I think 100,000 trades a day or more. Is there any practical way that that can be a recommendation or a suggestion to the banks?
You would need to, I cannot see it. I think you would need to ask the banks what mechanisms they had in place to reject the recommendation to buy or sell stocks.
And how often in 30 million purchases a year they did that?
In the documents that I saw and in the information provided to me by staff, I don't think they ever refused the direction of the hedge fund to buy or sell stocks.
The banks in Renaissance claim that that Renaissance is independent from the fund when it's acting as investment advisor to the banks. Did you see any evidence that they're independent from their own funds when they're acting as investment advisor, the label given to it?
No, I did not see any evidence that Renaissance, the general partner of the hedge funds, was independent when it bought and when it acted to buy and sell stocks for the banks. Renaissance was the general partner of the fund, and I should just say, in our financial structure, investment funds themselves do not have employees or computers or office equipment. They act through their general partner, and they incent the general partner to make money for them. So when Renaissance was managing the stock and the accounts at the banks, Renaissance was concerned in buying and selling stocks in order to make a lot of money for their partnership. They were compensated for that arrangement through fees, directly or indirectly, and they participated in the profits of the fund, which were staggering. I didn't see any sign that Renaissance was taking into account the interests of the bank in buying and selling stocks for the account.
Now, they had the authority to execute trades without prior approval. That was in the contract between Renaissance and the banks. They used the bank's trading execution system to place and execute several 100,000 trades a day to go into that so-called basket account. Now, why would it be important then for Renaissance to claim that these are recommendations rather than to acknowledge that they are actually executing trades in the bank's so-called basket account? What's the reason they make that claim?
Well, a key factor in tax analysis to determine who owns an asset is who controls the asset. And to the extent that the banks could assert that the hedge funds were not in control of the stocks in the account or the buying and selling of stocks in the account, that would yet bolster the argument that the banks and not the hedge funds were the owners of those stocks.
And they put in the contract documents that the bank could reject the trades. And would you agree that the reason that they put that in there is to give the appearance that the activity is not Renaissance, but the bank's, and that the bank is not a conduit for Renaissance's activity? Is that the reason that they would put that in a contract document, that they had the right to reject the trade?
Senator, I did not understand that representation when I saw it in the documents. That's at odds with my understanding of both the facts and the law, including Delaware law of partnership. So I cannot say why they made that representation. Perhaps wishful thinking. It's really hard for me to assess, why the representation was there. But as a factual and a legal matter, I just don't see how Renaissance, the general partner of the hedge fund, was not directing, influencing, controlling the buying and selling of stocks in that portfolio.
Now, Renaissance is the general partner of the option holders, Moselle and Badger. These are entities that were stated to be the holders of the option. At the same time, Renaissance is the investment advisor to Deutsche Bank and Barclays to manage the basket accounts. The parties assert that Renaissance, as investment advisor to the bank, is independent when it's making investment decisions for the banks and is not influenced by the option holders, Mosul and Badger. Now, how can Renaissance be independent from the option holders when it's their general partner?
I cannot see that. Earlier in the year, the First Circuit examined a private equity fund that claimed its general partner in managing its investments was not acting on its behalf. And the private equity fund argued, ignore the efforts of our general partner, we're not responsible for that for tax purposes. And the First Circuit rejected that analysis, a very important decision, Sun Capital. I believe hedge funds, private equity funds, and others take a rosy view of what they are engaged in. When their characterization helps them, they advocate it. But as a legal matter, I just can't see how, when an agent of a fund furthers the fund's efforts to make money, and that's the only objective of the fund, how the agent can disassociate its responsibilities to the fund and make money and assert that it's merely representing the bank when it's buying and selling stocks.
And so it cannot then, as a practical and real-world matter, be independent from the option holders when Renaissance is the general partner for those option holders.
Not in my view, sir.
Why would Renaissance and the banks set up that fiction that the investors in Mosul and Badger are independent of the investment advisor that is making the investment decisions for the basket accounts? Why would they make that claim of independence?
From a tax point, if that assertion were true, that might yet help the argument that the banks actually owned the securities. That is, the investment manager of those securities, those stocks, if that investment manager were independent of the hedge funds and acting at the direction of the banks, that would help the argument that the banks owned the stocks. Again, I don't see, either under the facts of the law, how that independence could be true.
Mr. Rosendahl, would you take a look at Exhibit 53?
Yes, Senator, I have that exhibit in front of me.
Okay, this is a June 2009 memorandum that Barclays wrote to its auditor, Price Waterhouse Cooper, PwC, concerning the deconsolidation of Palomino Limited. Now, Palomino is a Cayman Islands entity of Barclays, which was created to, in my view at least, quite clearly, to create an appearance that Barclays is the owner of the basket account where all the Renaissance trades were located and on which the option was based. This is also the same account where the profits that Renaissance earned on its trading done with Barclays was located. So that's Palomino. Now, this memorandum was written by Barclays Structured Capital Markets Group, which was responsible for developing the Colt basket option product. And it proposes to deconsolidate, to remove Palomino from Barclays' financial statements. So did you review that document?
Yes, I did, Mr. Chairman.
The memorandum sets out a number of significant facts and conclusions about Palomino and its relationship to Barclays and to Rentec that I'd like to review with you. First, take a look at page 7. Starting with paragraph A.
Mr. Chairman, can you point,
Yeah.
can you say the first few words?
Right,
My
right.
document is not paginated.
Yeah, mine isn't either, and I don't know where the page 7 came from, but that's okay. Yeah. It's the first, it's the page that starts with the heading consolidation analysis.
Yes, I have that in front of me.
Okay. Now, on that page, in paragraph A, it says, Palomino was created solely to enable Rentec to benefit through the Badger options and the Barclays options from its long, short statistical arbitrage strategy in an efficient manner. So it was created solely to enable Rentec to benefit. Now, if you look at paragraph B under decision-making, it says that, as described in section 7, in relation to the IMA, the PB accounts. PB, do you know what PB stands for?
Prime brokerage.
Prime
that's-
brokerage accounts are controlled by Rentec. Keywords there being the prime brokerage accounts are controlled by Rentec. The next paragraph I'd like you to look to is under benefits. C, near the bottom of that page, Rentec is effectively entitled through the Badger options and the Barclay options to 100% of the benefits from Palomino's trading activities, less any prime brokerage fees paid to BCI and BCSL, those are Barclays, in respect to the accounts. Did you follow me on that?
Yes, I did.
They're entitled to 100% of the benefits from Palomino's trading activities, Palomino being a Barclays creation. Then on the next page, near the bottom, where it says conclusion. Following the proposed amendments to the articles and the entry into the side letter, Rentec controls the major activities of Palomino and is exposed to substantially all significant risks and rewards arising from the activities carried out through those prime brokerage accounts being the only permitted activities of Palomino. And again, Palomino is Barclays' creation. Now, if these factual representations to Barclays auditors by Barclay are true, what does that say about whether the option basket is a true option?
If these representations were true, Renaissance, the general partner of the hedge fund, controls the basket of stocks, and as a consequence, the control is so large that I think one would need to conclude that the hedge funds, the principal for the fund for which Renaissance is acting, own the stocks as opposed to Barclays. And that seems to be the point of this memo for accounting purposes.
And they wouldn't have an option to acquire something they already own, presumably.
No, I'm trying to wrap my mind around this fiction of how you would have an option over something you already own. My view of the option is it reflects a contractual right to the basket of stocks in substance. And I think Price Waterhouse, or at least Barclays in these representations to Price Waterhouse, agrees with my intuition and my belief. And I believe that Price Waterhouse itself ultimately allowed Palomino to be deconsolidated, which I believe signals that Price Waterhouse thought that all vested control was in the hands of the hedge fund and not in the hands of Barclays.
And that it wasn't an option because they already controlled and owned it.
Yeah, they in effect own the stock, right?
Now, I'd like you to take a look at Exhibit 68, if you would.
Okay, I have that exhibit in front of me,
Okay.
yes.
Now, this is an excerpt from Barclays' annual report contained in its public filings with the SEC. And if you look at note 41,
Yeah, I'm turning to the back of the document and only see note 38.
at the top of the page it says 230, then it says 41 investments in subsidiaries. It's for 2009, is it Form 20F, is that what you got?
I've got a Form 20F,
For
yes.
2009, at Barclays PLC and Barclays Bank PLC?
I have that in front of me. Which page is that and what does
Well,
it start?
it's, again,
I apologize.
no, it's not, I don't have a page number, we have a note. It's at, is that 230 at the top? Is
Oh,
that-
here, I found on the second
is that a
page,
page number, 230?
I found the 41 investment in
Yeah,
subsidiaries.
230 is the page number,
Okay,
the top.
I see that, yes.
Now, if you look down in note 40, it says 41 in small print there.
Yes, I see that.
It says entities where the groups, now there's a Barclays filing with the SEC, right?
It appears to be so, yes.
Okay. And then it says, although the group's interest in the equity voting rights in certain entities exceeds 50%, or it may have the power to appoint a majority of their boards of directors, they are excluded from consolidation because the group either cannot direct the financial and operating policies of these entities, or on the grounds that another entity has a superior economic interest in them. So then it says, consequently, and there's the key words, consequently, these entities are not deemed to be controlled by Barclays. And then it lists two entities. One, Palomino Limited. So it's representing to the SEC, seems to me, that Palomino is not deemed to be controlled by Barclays. Is that what you read?
Yes.
Now, if Barclays is claiming in its public filing that it does not control Palomino, which is what you've been testifying to this morning, because it either doesn't direct the financial and operating policies of Palomino, or doesn't have a superior economic interest in Palomino, based on your review of the evidence that's gathered by the subcommittee, who does? Who does control?
Well,
I mean, they're representing, they don't control it. Is that a serious representation?
I think the hedge funds, through their general partner, Renaissance, control the accounts in Palomino, just like I believe the hedge funds, through their general partner, control the accounts held directly under Deutsche Bank. And I think that,
Is this a serious representation when you tell the SEC that you don't control Palomino?
I believe so. I suspect it's true, too, but
But is it also, I suspect it's true as well. In fact, our report says it's true. But it's
yes.
also something they're representing to the SEC, that they don't control it.
Yes.
And part of their argument is that they do control it. I think we may hear that argument this morning. But in any event, they claim here that they don't control it. And what they're saying is, the reason they don't control it is because they don't, it says here, they don't direct the financial and operating policies of these entities. They don't control, they say. They don't direct the financial and operating policies of Palomino, or another entity has a controlling interest. So is this not an acknowledgement in a very significant way to a federal regulatory body that they do not direct the financial and operating policies of Palomino?
I would say yes, although there's the word either here, and I don't quite understand this formulation. Either cannot direct the financial and operating policies.
No, it does
or
not.
on the
Does
grounds.
not direct.
Yes.
Does not direct.
Yeah, it's or on grounds that another entity has a superior economic interest in them. In either
That another entity has a controlling interest in them. So on either grounds.
That's correct.
And either-
Barclays is not viewed as controlling Palomino under this disclosure to the SEC.
And if you look at the next representation for the year 2000, that was 2011. In 2012, are they telling the SEC, if you look at, it's the same exhibit, it's 2012. You see where they're the same, it's footnote 38 in this case?
Yes, I have footnote 38 in front
And
of
they
me.
say that they're excluded from consolidation. They're not even showing Palomino as being owned by them on their SEC form because they don't direct the financial and operating policies of these entities, or another entity has controlling interest for one or the other reason. They're not even going to show ownership because another entity has a controlling interest, or Barclays does not direct the financial and operating policies of Palomino, right?
Correct, at the bottom.
And that's something you would agree with, from what you know.
From what I saw independently of the documents, I think this representation to the SEC is correct, that Palomino was not controlled by Barclays. In effect, through the operation, if you look to the economic and financial activities, of Palomino, which in that instance, the structure for Barclays was to set up a special purpose entity which only held accounts to facilitate the trading for Renaissance. And I think that these assertions, quite logically so, suggest that Renaissance controls that trading and those accounts and not Barclays.
Yeah, but at least Barclays sure doesn't. And that's what they represented to the SEC. Same thing, and take a look at the next year, 2013. Here again, Palomino, country of registration or incorporation, Cayman Islands again. Can you see that that's it's note 38 this year? Do you see that?
Yeah, I see the same words there.
But it's a little, they actually, it's slightly different words.
Oh.
I mean, it's same impact. They're excluded from consolidation. They don't want to even show them as owning this because the group, Barclays, does not have exposure to their variable returns. And these entities, that's Palomino, are managed by external counterparties and consequently are not controlled by the group. Same effect, slightly different words. Is that correct?
Yes, thank you for highlighting those slightly different words. Actually, I think the only counterparty to Barclays here would be the hedge fund. I don't believe that Renaissance, the advisor, would be viewed as a counterparty. Normally, the term counterparty is used in connection with the derivative, the ones who have the economic interests. So I think these words point more directly to the hedge funds.
Which is what you've testified to.
That's how I viewed the arrangement, consistent with these descriptions, yes.
So they're representing to the SEC what you say is the real-world situation, that the beneficial owner of that account was Renaissance.
Yes, it appears to me that way, yes.
Year after year after year, that's what they say to the SEC. Now, the evidence shows that Renaissance on a daily basis made hundreds of thousands of these rapid-fire trades. That's an average of, by the way, 3 per second, using its trading discretion that they were given by contract in the bank's basket accounts. And I think you've testified this in your opening statement, but I want to just ask you to expand a bit on it. Do you have a view as to, and you talked about a turnover in 6 months, I believe, was like 97%. What was the turnover, do you remember?
The turnover in 3 months' time was about 87%.
And in 6 months, do you have the number? I think it was 97, but anyway.
Something like that.
Does that give rise to a fundamental or material change to the composition of the basket options so that these changes to the underlying positions should be deemed exchanges of property and therefore taxable events under the code?
Yes, I believe so. I believe that that argument, though, only holds if the basket contract were respected. I think in the first instance, I think the basket contract combined with the investment management agreements reflect direct ownership of the underlying assets, and therefore gains and losses would be recognized at the time that the underlying assets were bought and sold. But on the chance that some court might, yes, disagree that there is in fact a contractual right only to the return and not to the underlying assets, I think that contractual right has been fundamentally changed as the portfolio turns over. And so I think the hedge funds would have a very uphill battle to persuade either the IRS or a court of law that the gains that they reported as long-term and deferred really were long-term and deferred.
So this is a second reason why they'd have a problem with what from a tax perspective, from what the claim of the long-term gain is.
Yes, a second and independent reason, yes.
I have a few questions for the GAO, but Senator McCain.
I want to thank the witnesses. Could I say that there are many people who are watching this hearing. And there's many people like me that are not as familiar as you are with how this whole system works. So maybe for the record, and by the way, we'll have to proceed on the assumption there's no such thing as a dumb question in my questioning you. How does this thing work? In other words, what is the technologically advanced algorithm? How they employ real smart people? Tell, just for the record, how does this whole system work that they've invented, which allows them now to have nothing but profits throughout the entire time, no matter what the rest of the nation and the world's economy does? Could you, for the record, Mr. Rosenthal or Mr. White, either one or both, explain exactly what's taking place here?
Well, we are at some handicap. These Renaissance funds were incredibly profitable.
This is a hedge fund,
Yes, a hedge fund, yes.
And
It
they-
buys and sells stocks.
Right.
It pursues a strategy which has been tremendously successful. And understandably so, the funds were reluctant to share exactly what they did. But I think what they did was described as statistical arbitrage, and I'm familiar generally with what statistical arbitrage entails. Statistical arbitrage entails trying to determine relationships between a couple of different assets and determine whether or not the price of one of the assets is out of kilter. Too low, you might buy. Too high, you might sell. And so, for instance, you might buy Ford Motor and sell short Chrysler depending on the price of steel. Maybe Ford uses steel more intensively in its manufacturing
And that
process.
decision is made by really smart people they hire that
Really
do
smart people.
intensive study and investigation.
Really smart
And
people.
what does
yes.
the use of algorithms, where does that enter into it?
Well, as I understand the algorithm, in the 1990s, one of these really smart people, a PhD from Berkeley, created the algorithm, which, as I understand it, is a collection of different strategies or pricing signals to determine what to buy and what to sell. And throughout, the Renaissance Investment Advisor, which has more than 200 and 250 employees, including 90 PhDs, math and science PhDs, continue to tweak the model, search for pricing relationships, look for good investment opportunities, and they're very successful. They can spot mispricing that may be fleeting days or weeks and profit by it.
Now, is Renaissance one of the most successful of all hedge funds because of this?
I believe so, Senator, based on my Google of the company. They are tremendously successful, very profitable.
So basically, they're not fundamentally doing anything wrong. It's that they're just smarter than a lot of other analysts and hedge funds, et cetera.
Well, at its core, statistical arbitrage is a perfectly sensible and a fair strategy to pursue. Yes.
But the question here is, are they paying their taxes that would be appropriate for the transactions they're engaged in?
Not in my view, Senator. In my view, their strategies fundamentally are short-term strategies. And at the start, Senator, in your opening statement, you described how the average investor looks at some of these arrangements and says, that's not fair, I can't do that. And if you were to look to an analogy of what Renaissance funds did to what I, as an average investor, might do, I cannot instruct my broker at the end of the year after I bought and sold stocks, IBM, AT&T, and the like, I cannot instruct my broker, please do not send me a 1099 listing the individual gains and sales from my stocks. Instead, please send me after a year and a day my net profits so that I can view that net profit as a payoff of a long-term investment. I can't do that with my retail broker. My broker sends me statements that reflect the short-term strategies that I pursue when I pursue a short-term strategy and long-term gains when I incur a long-term gain, when I'm fortunate enough to have a long-term gain.
But
That's not what's happened here.
That's not what's happened here. So what has happened here?
What's happened here, in my view, Senator McCain, is that the hedge funds wrapped a derivative around their short-term trading strategies. That rather than view the short-term trading strategies as being owned and the benefits passing through directly as sales occurred, those gains were simply accrued and reinvested in new positions and were only cashed out when the derivative that wrapped itself around the strategy was terminated and the gains passed through by the bank to the fund. And as I said, the funds took the view that by arranging the wrapper, this derivative around the strategy, that the tax law would ignore the short-term nature of the trades underlying the derivative and look only to the longer-term contract. I don't think that would withstand judicial scrutiny, that position, Senator.
Mr. White, I noticed you want to make a comment on this exchange here.
Senator, yes. We didn't, at GAO, review this particular transaction. I want to be clear about that. What we did review was IRS's ability to audit large partnerships. And many of these hedge funds, as I said in my statement, are structured as large partnerships. So IRS, what we found, is hindered in its ability to audit these kinds of entities. One of the problems is finding these kinds of transactions. If you have a tiered structure, IRS auditors have the problem of finding the ultimate source of the income because what they need to do is audit the transaction, such as this particular transaction that's the example today. The other problem that IRS faces is if they do find the transaction and make an audit adjustment, they then have to find all the partners in the structure to pass the change through to.
So what do we do?
There are a couple of things that we're looking at. We're not done with our work yet. We'll be issuing the final report in the fall, but there are some options here to simplify the audit process for IRS under the TEFRA rules. One problem that we cited, the auditors told us repeatedly, they have problems finding the so-called tax managing partner, the representative of the partnership with whom they deal with in an audit. Right now, under the law, it's not required that that tax managing partner be listed. The tax managing partner, if it is listed, may not be a human being. It may be another partnership. And IRS auditors told us this can delay their audit work by months. And given the statute of limitations, they may run out of time to complete an audit. So that's one option.
Right.
Another possibility is assessing the tax at the entity level, at the partnership level, and avoiding the problem of having to pass the tax through to the partners.
Well, right now, according to you, the IRS is auditing 0.8% of the large partnerships in the United States.
Yes.
That's not exactly a deterrent to misbehavior.
Especially when you compare it to the audit rate for large corporations, which is, as I said, 27%, 33 times higher than 0.8%.
So, Mr. Rosenthal, we're really talking about de facto tax avoidance here. Is that correct?
I think that's correct, Senator. That is, we have a situation in which the hedge funds engage in very complicated transactions, and in this instance, in ways that I do not think would withstand judicial scrutiny. But having the IRS find the transaction and having the IRS audit the transaction effectively is not going on. I believe from a prior GAO report, the IRS stumbled across these transactions through a tip from the SEC. So there's real problems on the audit side from the IRS. I would say TEFRA was enacted in 1982, I believe, to simplify partnership taxation, to make it easier for the IRS to conduct audits at the partnership level, yet to provide some information rights to the partners to make sure the partners knew what was going on. The TEFRA rule is designed to simplify. In fact, it's created quite a mess. I worked on the reform of the TEFRA rules in '93 when I was at the Joint Committee on Taxation. I think Mr. White is correct. Further reform might be desirable. But I don't, my personal view is that's not the fundamental problem here. I mean, there are two fundamental problems in my view. One is these derivatives are just so complicated and so opaque that to get the IRS to have the resources to
So is
sort
the-
them through.
Could I interrupt
Yes,
you right
sorry.
there on the first one? So does that mean you rule out such transactions?
No, on the first one, on how to view derivatives,
Yeah.
I think they serve a valuable commercial purpose. Yet, I believe what we ought to do is require derivatives to be accounted for as if they've been sold every year. Chairman Camp of the House Ways and Means Committee examined derivatives closely, and in his tax reform proposals recommended that derivatives simply be marked to market, that is, treated as if they're sold each year, and the net income or loss recognized each year. That would help immensely to try to neuter the complexity and the difficulties of the IRS in unraveling these derivative arrangements, and would in effect come very close to the true income from the derivatives. And that was the approach that Chairman Camp proposed and then reproposed. I think that was a sensible approach.
Your second point, I interrupted you.
Oh, my second point is it's a question of resources, I think, in part to the IRS. As you suggest, Senator, a 1% audit rate for an increasingly large segment of our economy just invites the most aggressive behavior. And it's unfortunate. I've practiced for many years, and I've seen this scenario from so many different spots. You can find advisors who will write aggressive opinions, whereas most advisors would not opine that a transaction works. You can find taxpayers which will take aggressive positions in circumstances in which many other taxpayers would not take advantage of a situation that they didn't think was appropriate. And in effect, what you have is the aggressive driving a race to the bottom. The competitive pressures amongst professionals and amongst taxpayers are only enhanced by the lack of enforcement and regulation by the IRS. And so the situation is very challenging. So again, I would try to think of systemic ways to make the audit and the taxation of derivatives simpler, but then you also, in my view, need to give the IRS more resources to do their job.
Thank you, Mr. Chairman.
Thank
Thank
you.
you.
We'll vote in the Senate now, the first of three votes. I'm going to run over there now and try to catch two votes together, and then I'll probably just have to miss the third vote because we're going to come back and continue and work through these. But I just want to make it clear that do you agree, Mr. White, that the IRS has recently experienced budget reductions that do constrain the resources that are potentially available for large partnership audits?
Yes, its overall resources have been cut. Furthermore, what's going on here is you've got this very rapid growth in large partnerships. C corporations are shrinking somewhat, but not enough so that IRS could reallocate resources from those audits, which are productive audits. Audits of corporations brings in several tens of billions of dollars to IRS. So reallocating resources away from those audits to large partnerships doesn't seem to make sense.
All right, thank you both. We are going to, you two are excused. We're going to move to our next panel in probably 10 minutes. So we will recess for 10 minutes. Oh, yeah, no, I just have to get. The subcommittee will come back to order. Now we'll call our second panel of witnesses. Martin Malloy, Managing Director of Barclays in London. Satish Ramakrishna, the Managing Director of Deutsche Bank Securities, Inc., and Global Head of Risk and Pricing for Global Prime Finance in New York. Mark Silber, the Executive Vice President, Chief Financial Officer, Chief Compliance Officer, and Chief Legal Officer of Renaissance Technologies, LLC in New York. And Jonathan Mayers, Counsel for Renaissance Technology, LLC in New York. Thank you all for being with us this morning, and thank you for the cooperation of the banks and of Renaissance. We appreciate that. Pursuant to Rule 6, all witnesses who testify before the subcommittee are required to be sworn, so we would ask you to please stand, raise your right hands. Do you swear that the testimony you're about to give before this subcommittee will be the truth, the whole truth, and nothing but the truth, so help you God? We'll be using a timing system today, and about a minute before the red light comes on, you'll see the lights change from green to yellow, giving you an opportunity to conclude your remarks. Your written testimony will be made part of the record in its entirety, and please try to limit your oral testimony to no more than 7 minutes. Mr. Malloy, we'll have you go first, followed by Mr. Ramakrishna, then Mr. Silber, and then Mr. Mayers. Thank you. Mr. Malloy.
Good morning.
Good morning.
I am Marty Malloy, and I currently serve as Managing Director and Head of Barclays European Prime Services Unit. From 1998 to 2008, I headed the equity finance team of Barclays Prime Brokerage Group. In this capacity, I oversaw the execution of the Colt transaction with Renaissance Technologies. In the last 18 months, I have met with the subcommittee staff on several occasions in an effort to assist your review and analysis of the Colt transactions, and I'm here today as a further continuation of my and Barclays' cooperation. Barclays and Renaissance first entered into the Colt transaction in the fall of 2002, and they were already a customer of the bank at the time. Renaissance proposed aspects of a structure that ultimately became Colt in connection with ongoing discussions regarding potentially expanding its business relationship with Barclays. Over the past 12 years, Barclays and Renaissance have entered into a number of Colt transactions. This is a commercial transaction from which Barclays earns fees in a number of ways. On option trades like this one, the bank realizes income from the spread on our execution of our principal trades. Additionally, Barclays benefited from being able to both pledge as collateral and lend out the securities held by Palomino. Before putting on the first Colt option, and when subsequent options were considered and approved, Barclays subjected the transaction to an extensive internal review process and consulted with both internal and external regulatory and tax experts. The Colt transaction, like any transaction, poses certain risks to the bank. In particular, Barclays bears gap risk associated with being the holder of the basket of securities. For example, over a period of several days in August 2007, this portfolio, like others using statistical arbitrage strategy, suffered higher than expected losses. The portfolio eventually rebounded, and the losses did not exceed the limit levels that would have triggered an automatic unwind of the transaction. These risks were mitigated by features of the transaction, including Barclays' right to unilaterally unwind the transaction if losses exceeded the amount of the premium paid by Renaissance on any existing option. There is also a monitoring system to oversee performance of the reference portfolio and certain limitations such as concentration and skew limits. While Barclays had the risks and protections I just described, the Colt transaction was unique in at least one important way in that it was non-recourse. In other words, unlike other transactions in which the bank provides financing, With the Colt transaction, we cannot pursue legal remedies from Renaissance in the event the portfolio suffers losses in excess of the amount of premium paid. An issue raised by this subcommittee is whether historically Renaissance has applied the correct tax rate to its earnings from the Colt options. The IRS issued generic legal advice in 2010, but to my knowledge, the IRS has issued no further guidance or decisions on these transactions. Although Barclays feels strongly that this transaction was subject to sufficient and significant internal and external review to ensure it complied with applicable tax laws and regulations, ultimately the question, what tax rate should Renaissance pay, is a question to be resolved between Renaissance as the taxpayer and the IRS. I hope my testimony has been helpful, and I will do my best to answer the subcommittee's questions. I should note that although I have been involved with many aspects of this transaction over the course of its execution at Barclays, I have not been responsible for the deal's day-to-day operations since May 2008. To assist the subcommittee, the bank has done its best to collect as much information as possible related to this transaction, and therefore, at times, my testimony and answers will reflect not my personal knowledge, but what I have been informed of by others working at the bank. Thank you.
Thank you very much, Mr. Malloy. Mr. Ramakrishna.
Chairman Levin, good morning.
Good morning.
My name is Satish Ramakrishna. I am a managing director and the global head of risk and pricing for Global Prime Finance at Deutsche Bank Securities. I am currently based in the New York office of Deutsche Bank, and I've been with Deutsche Bank for approximately 16 years. Before I became a risk manager in 2007, the job that I do now, I was an equity derivatives trader. I ran the structured products derivatives desk for Deutsche Bank in New York and later ran a derivatives desk in London. As a result, I have extensive experience performing quantitative analysis of equity derivatives, including pricing and evaluating the risk profile of various options. My colleague Barry Bassano and I have submitted detailed written testimony. I want now to briefly describe some of the specific features of the MAPS product at Deutsche Bank and provide some background on how and why we developed what we call new MAPS in 2008. Mr. Bassano will then provide you with a brief overview of the MAPS product at Deutsche Bank. MAPS was an option on a trading strategy. The option buyer, a hedge fund, paid a premium to Deutsche Bank to purchase the option. If the strategy did not generate gains in excess of the initial premium, the buyer simply paid for the costs and benefits of the option and received the remnant value in the option at maturity. However, if the strategy generated positive returns, the buyer received the amount of those returns less the costs and fees for the option paid to Deutsche Bank. The bank engaged an investment advisor affiliated with the option holder to run the trading strategy within strict parameters and to purchase and short in the bank's own account the securities or positions that comprise the strategy as a hedge to the option. While the bank's exposure under the option was hedged, MAPS was not without risk to the bank, particularly absent the controls which we put in place. If the value of the securities held in the account fell below the barrier price of the option, the bank bore all losses. The extent of this risk became clear to me in August 2007, a few months after I joined Prime Finance as a risk manager, when hedge funds employing a statistical arbitrage market-neutral strategy experienced what has come to be known as the quant quake. The quant quake demonstrated that such funds were riskier than believed because of the high correlation in the positions held by different funds employing similar strategies. As a result, in late 2007, I began to consider ways to provide the bank with better protection if the value of the portfolio of securities the bank was holding relating to MAPS suddenly dropped. At the same time, those in the bank's control functions, including legal, tax, and compliance, were assessing MAPS in light of ongoing dialogue and observations concerning the regulations surrounding derivative products. Those efforts were merged together as we at Deutsche Bank worked to restructure MAPS and develop new MAPS in 2007-2008. The MAPS restructuring included a number of changes. Let me highlight three of them. First, new maps included key risk reduction terms that provided the bank with certain rights at declining levels of account value and that required the investment advisor to follow a defined, balanced, and liquid investment strategy. Second, the new MAPS agreements further provided that the securities traded for each option would be held in separate sub-accounts and the options staggered in maturity for risk purposes. Third, new MAPS was changed from an American-style to a European-style option, which could not be terminated early without forfeiting a significant part of the premium. In addition to these changes to the product, we took steps to improve internal controls and apply intraday risk management, thus better managing the bank's risk under new MAPS. I also ensured that the revised option price calculation accurately compensated the bank for its risks and costs. Pricing was done through the use of traditional option pricing methods, and the strike price was adjusted so that the cost of the option and the financing cost of the portfolio were reflected in the strike price of the option. In sum, we priced new MAPS as an option, managed it as an option, and documented it as an option. We did so because MAPS was an option, and the bank was compensated for and managed its risk accordingly. Thank you for this opportunity to speak to you today, and I look forward to answering your questions.
Thank you very much. Next will be Mr. Silber.
Thank you. Chairman Levin, members of the committee, good morning.
Good morning.
My name is Mark Silber, and I appreciate the opportunity to present a brief opening statement on behalf of Renaissance. Renaissance's mission is to produce superior financial results by adhering to mathematical and statistical models in the design and execution of trading strategies. Our equity trading and advisory activities add liquidity to the markets, reduce inefficiencies, and improve capital formation. We have invested billions in the research that supports our models, and we have been very successful, but we know that past success does not eliminate future risk. I want to be clear. Renaissance's Medallion Fund purchased barrier options from Deutsche Bank and Barclays for substantial non-tax business reasons. We would have purchased these options regardless of their tax treatment. I can confidently speak to our motivations for buying these options because I have been a part of the Renaissance leadership team for over 30 years. When we exercised a barrier option held for more than a year, we reported any gains resulting as long-term capital gains in accordance with current tax law. We reported short-term capital gains on options held for less than a year. If the tax law relating to barrier options changes in the future, we will, of course, comply. Under current law, derivative instruments permit higher leverage than many other forms of investment. Again, if the rules concerning leverage change, we will comply. Medallion purchases barrier options to obtain a combination of leverage and loss protection that we have been unable to obtain through any other means. This is entirely permissible under current law. The Joint Committee on Taxation has recognized that derivatives are critically important tools in the risk management process, and that, compared to actual stock ownership, derivative contracts typically afford a party much higher leverage than would be commercially possible or permitted by relevant margin regulations. Our options are not prime brokerage accounts with more than normal benefits. They come with a different bundle of rights and obligations. Owners of stock in prime brokerage accounts receive customer protections in bankruptcy and other benefits that we do not. For example, if one of our counterparties were to collapse or default, as Lehman Brothers and other large institutions have recently done, we would be a general creditor at the back of the line with no guarantee of recovering any portion of the value of the option. We have accepted these trade-offs in order to obtain greater leverage and loss protection that is not available in prime brokerage. The way in which we have used the barrier options also demonstrates that we were driven by business imperatives. The average holding period of the Deutsche Bank options from 2000 through 2009 was around 450 days. For Barclays, it was around 400 days. After the August 2007 quant quake, we exercised the Barclays option after only a few months and then did so again in 2009 during the market turmoil surrounding the financial crisis. Today, all of the new options that Medallion enters into have terms of less than 1 year. Like all prudent investors, we were also mindful of the tax consequences of our actions. This is entirely permissible and in no way negates the compelling business reasons that led us to enter into these transactions. As you know, the IRS has been reviewing these options for over 6 years now. Renaissance has been cooperating fully with that review and is working through the issue within the IRS's established process. Frankly, we wish things would move faster. Ultimately, we expect to prevail because we have complied with the law. We also note that Congress many years ago gave the IRS the authority, in Code Section 1260, to prospectively change the taxation of options like these, and it has not done so. We appreciate the opportunity to be here today to explain our transaction, and we look forward to your questions.
Thank you, Mr. Silber. Mr. Mayers.
Senator Levin, Mr. Silber's remarks were on behalf of Renaissance as a whole, and I will not be making a statement separately.
Thank you. Okay, let me first ask you some questions, Mr. Silber. In the basket deals with Deutsche Bank, Rentec used two different entities to purchase the options, Franconia and then later on Mosul. Franconia was a Bermuda corporation, and it was used by Renaissance to be the option buyer in 20 basket deals between 2000 and 2007. Mm-hmm. How many employees did Franconia have?
None.
Who controlled Franconia?
Renaissance as the general partner.
Now take a look at Exhibit 6, if you would.
I have that exhibit.
If you take a look at page 1, it stated that Rentec was authorized without further approval by or notice to the client, that's Franconia, to make all investment decisions concerning the account. Is that correct? You see that?
I'm looking for it, but I believe that is correct.
Okay. Now, in terms of Rentec's control over Franconia, if there were any doubt, take a look at the signature page. Who signed that agreement for Renaissance?
I did.
And who signed on behalf of Franconia?
I did.
So you're signing that deal with yourself. More significantly, Renaissance is signing a deal with itself. And the company is such a shell that you, as an executive officer of Rentec, sign all of the papers. Now, the next entity Rentec used in these basket deals was Mosul. Am I pronouncing that correctly?
Yes, sir. Yes, Senator.
Mosul was a Delaware partnership. It has been used by Rentec to be the option buyer in basket options between 2007 and 2010. It has also entered into all of the short-term deals that Rentec and Deutsche Bank have entered into since 2012. How many employees does Mosul have?
None.
And who controls Mosul?
We do as general partner.
Take a look at Exhibit 8, if you would.
Yes, sir.
This is a copy of the limited partnership agreement for Mosul. Rentec is Mosul's general partner. According to page 6 of the agreement, the general partner, subject to the terms and conditions of the agreement, quote, shall have complete and exclusive responsibility for managing and administering the affairs of the partnership, and shall have the power and authority to do all things necessary to carry out its duties hereunder. Do you see that language?
Yes, Senator.
Okay. Now, look at the signature pages 15 and 16. Who signs for Rentec?
I did.
And who signs for all of the partnerships that are the limited partners.
I did.
Full control by Rentec. Rentec's general partner of Mosul is also the agent of Mosul, is that correct?
We're the general partner of Mosul.
Are you the agent of Mosul?
As general partner, we had all the authority and responsibility for the activities.
Now, I want to explore some of the fictions that I've referred to in some detail, and we're going to do so by looking specifically at the option deals involving Rentec and Deutsche Bank. What the bank and the hedge fund want is to create a reality, an alternate reality, in which Rentec can borrow lots of money from Deutsche Bank to make millions of short-term trades while both avoiding leverage limits and Rentec also being or claiming long-term capital gains rates. And the vehicle to create that alternate reality is a basket option that derives its value from a basket of securities that sit in a Deutsche Bank account, but that Rentec can change the mix of the assets in the basket as it wishes. The idea, however, of a hedge fund holding an option whose value derives from an account that that same hedge fund controls would be absurd, to have an option on yourself. So to maintain the fiction of a real option, Rentec creates an entity that it owns, Franconia, to hold the option. Rentec controls the Deutsche Bank account. The created entity, Franconia, holds the option on the account. That supposedly sets up a wall between the entity controlling the trades and the entity controlling the option. But on even the most cursory examination, that wall crumbles. These two entities are one entity, as we can see from the chart in front of us. Now, Mr. Silber, take a look at Exhibit 7. If you would, it's a confirmation document. For one of the basket deals between Rentec and Deutsche Bank in 2002. You see where the heading there is Deutsche Bank, and it says Franconia, it's addressed to Franconia
Yes.
Equities, care of Renaissance Technologies,
Yes.
okay? Franconia, again, the Rentec-controlled shell, is the option buyer. Deutsche Bank is the seller. Now, if you look at one of the representations made in this document, on the bottom of page 10, in Article 5, there's a representation in that article that the buyer, that's Franconia, has made an independent judgment of the experience and expertise of the investment advisor. The investment advisor, the Deutsche Bank, is Rentec, who we've already seen is the investment advisor for Franconia, wholly owned by Rentec. Franconia owns it, controls it. Franconia has no employees. Now, how can Franconia be able to make an independent judgment of Rentec?
I'm missing some. I'm sorry, Senator. I see where the
That-
seller
At the last line, the buyers made an independent judgment of the experience.
and expertise
And
of the investor.
expertise.
That's correct. Franconia is an investment vehicle owned by ultimately the beneficial owners of the fund, Medallion Fund, which was the owner of Franconia. Rentec is is an independent entity which acts as investment advisor to both Medallion and Franconia.
Right. So how can Franconia make an independent judgment of the experience and expertise of Rentec? It was created by Rentec. It has no
It was.
employees.
That is
So how does
correct.
it make an independent judgment?
We as the
Who
general.
makes the judgment at Mosul?
Renaissance
I'm sorry,
acting,
at Franconia. Who makes the judgment?
Renaissance acting as the general partner with duties to the fiduciary duties to its investors, is speaking on behalf of those investors with regard to Rentec, the same entity, in its role as investment advisor.
So Rentec's making a judgment on Rentec.
It is. That is.
Okay? If that's your definition of independence, I'd like to find the dictionary. Send me a copy of the dictionary that has that kind of a definition of independence, making a judgment on yourself. So take a look, if you would, please, at page 11 of that same document. And then in the second paragraph there under investment advisor, it says, other than is provided above, buyer agrees, that's Franconia, it shall not contact directly the investment advisor, that's Rentec, regarding the terms or subject matter of this transaction. How is it, under any definition, conceivable that the buyer, Franconia, with no employees, will not contact directly the investment advisor that creates it regarding the terms or subject matter of this transaction? How is it possible?
I agree. I don't understand, that sentence may not have been relevant to this transaction.
But it's not quite, it's highly relevant, trying to create a fictional wall. I'm just asking, how is it conceivable, under what definition is it possible that Franconia, with no employees, agrees that it won't contact the investment advisor, which is Rentec, regarding the terms and subject matter of this transaction? Would you agree that's not feasible, physically?
In this circumstance, I think you're correct.
Now, Deutsche Bank in 2008 revised its basket option product called MAPS. And Moselle then replaced Franconia as the option buyer on behalf of Rentec. Please take a look at Exhibit 27. If you look at page 21, this is the agreement now between Deutsche Bank and Moselle Equities, care of Renaissance. This is the confirmation, so-called, for a basket deal in 2009. This is after the restructuring of MAPS. There's a representation, if you would, on page 21 near the top.
Yes, sir.
End of paragraph 5, the buyer, so now it's Moselle, agrees that it shall not attempt to direct or influence the choice of investments in the basket. The investment advisor to the Deutsche Bank account, the entity making the decisions for the trading account, is Rentec. The company controlling Moselle is Rentec. Rentec is the agent of Moselle. So how can Moselle represent the Deutsche Bank that it will not attempt to direct or influence the choice of investments in the basket when Mosul and Rentec are really the same entity. How's that possible?
Senator, Renaissance is playing two different roles in this transaction. With regards to the option, it is recommending trades for the reference basket. And with regard to Deutsche Bank, we're recommending and initiating trades for their hedge portfolio.
Would you agree that Mosul and Rentec are the same entity?
They're not the same entity. They're both controlled by Renaissance, but they have different ownership.
Well, Renaissance controls Mosul,
Renaissance manages and has control of the activities of Mosul.
and so Mosul is controlled by Renaissance.
On an activities basis, that's correct.
So Mosul's now agreeing it won't attempt to direct or influence the choice of investments in the basket, but it, the entity that controls it, will.
And it's correct. I think Renaissance is.
Renaissance controls it.
Renaissance-
They are going to make the decisions.
And when we make the
But
decision,
then, excuse me, but then Mosul is saying, but Mosul won't do it. The person that owns this, the entity that owns this, is going to do it. The problem is, it doesn't say that anywhere here, does it?
no, it does not. Renaissance does not own Mosul, it controls
It
Mosul.
controls Mosul.
So
Mosul is telling Deutsche Bank, hey, we're not going to make a recommendation, but the entity, it doesn't say, that controls us is going to make the recommendation, right?
In its role as advisor to the Deutsche Bank, that's correct.
Okay. Now, Mr. Ramakrishna, you signed this document on behalf of Deutsche Bank, and you are familiar with the operation of the basket deals.
Yes, sir.
Do you think it's possible that Mosul, totally controlled by Rentec, could not be influencing the, would you agree that Rentec not only influenced the choice of investments, it made the decision on investments? Would you agree that?
I think we did realize that the option buyer and the investment advisor were affiliated.
Not affiliated, that Rentec controls Mosul. You knew that.
We knew there was a relationship. I can't speak to the control feature. It's not something I'm an expert on.
Well, but now that you know that Mosul's owned by Rentec, does it make any sense for Mosul to represent to you that it's not going to be making any decisions relative to what's in that basket? It doesn't add parenthetically, but the entity that owns this is, right? Rentec controls Mosul. So Mosul is telling you, Deutsche Bank, we, Mosul, we're not going to make any recommendations to you. What you don't add in that agreement is, hey, but the entity that owns us is going to make those decisions. Doesn't that change the whole nature of the contract? If they said that the facts are that Rentec owns Mosul, you're told in this contract, Mosul represents to you, Deutsche Bank, that it is not going to make decisions relative to what's in that basket, right? That's what it's telling you.
Senator, I'm not an attorney in this, and I'm sure the word control means something
That means a lot.
special.
No, it means what it says. You signed the agreement, didn't you?
Yes, I did, sir.
Did you understand what you were signing?
I think I did, yes.
And did you understand that Mosul, which signed the agreement with you, owned by Rentec, representing to you that it's not going to make decisions? Did you understand that the entity that owned it, Rentec, operated, that owned Mosul, was going to be making decisions? Did you know that when you signed it?
We definitely knew that the two were connected.
No, but did you know that Rentec, when you were told in this agreement, it was represented to you that Mosul was not going to be making the decisions? Did you realize and understand that Rentec, the party that was making the decisions in its agreement with you, owned Mosul? Did you know that?
I don't think I knew personally if Rentec owned Mosul, but I do know that the two were strongly connected.
Senator Johnson?
Nothing right now, Mr. Chairman.
Okay. Okay, let me just ask you, Mr. Silber, the entities that were involved in the Barclays Rentec basket deals were similar to the ones that were involved with the Deutsche Bank Rentec deals. In the deal with Barclays, Rentec used two different entities to purchase the basket options. Bass Equities was a Cayman Island company that was used by Rentec to be the basket option buyer in 8 basket deals between 2000 and 2004. Badger was a Delaware partnership, and it's been used by Rentec to be the option buyer in 31 basket options between 2007 and 2012. Mr. Silber, you signed all the formation papers for all of the parties. Rentec controlled Bass and Badger, and Rentec was the investment advisor for the Barclays option account, which was held in the name of a Barclays special purpose entity called Palomino. Is that correct?
Yes, Senator.
Okay. And you were the investment advisor to Bass and Badger, is that correct?
Yes.
Mr. Mayers, and by the way, Senator Johnson, whenever you're ready, let me know, and be happy to yield to you, because I'll be going on for some
Yeah,
time.
unfortunately, I missed the first part.
Okay. Mr. Mayers, a critical event regarding the question of who controlled the bank accounts occurred in 2009, when there was a change in the Articles of Association of Palomino, which is the Bermuda entity that Barclays used to hold the account related to the basket transactions. It was followed by a side letter that effectively gave Renaissance power to approve changes to Palomino's Articles of Incorporation. So we have a situation here where Palomino their activities were restricted to those that it was currently engaged in by that side letter. Basically, Palomino was restricted to basket option transactions with Renaissance and could only use Renaissance as the investment advisor to the Palomino account. Mr. Mayers, I believe you told subcommittee staff that Rentec wanted to make sure that it could mitigate as much as possible the chance that Barclays could unilaterally undertake some activity that could void the investment management agreement and possibly terminate the option, because Rentec wanted to preserve the access that it had to the leveraged financing. Is that correct?
Senator, in the context of the discussion with your staff, which you are referring to, I advised that by the time I got involved in the side letter discussions, the reasons for them had been, it had already been decided that it was going to be done. My role at that time was to review the documentation to see how it affected the rights and obligations as far as the option transactions were concerned. In reviewing those documents, the first thing that I noticed was that it did not negatively affect these rights and obligations. And as you correctly correctly state, I was thinking that there may be a benefit in that side letter. I've since gone back and can see no way how where that benefit can accrue.
Now, back to Mr. Malloy. Barclays had discussions with Renaissance about changes to the Articles of Association. Is that correct?
Yes.
And the problem was that since Barclays was the sole shareholder of Palomino, Barclays could always go back and eliminate the restrictions in Palomino's Articles of Association. So in order to ensure that the restrictions on Palomino would stay in place, Rentec and Barclays entered into a side letter. Would you take a look at Exhibit 55, please?
Yes.
Now, this side letter, at the last, second from the last paragraph, addressed to you, Mr. Malloy, by Renaissance Technologies, signed by Mr. Silber, stipulated that the amendments to Palomino's articles would not change the obligations and duties that Barclays and Palomino had to Rentec regarding the basket transactions. In addition, the side letter said the following, and this is what I'm reading to you from that second from the last paragraph. Barclays hereby further covenants to Renaissance that it shall not make any amendments or modifications to the memorandum and articles of association of Palomino after the date hereof without first obtaining the prior written consent thereof of Renaissance, provided that the investment management agreement has not been terminated by either Palomino or Renaissance. So what you do is you give Renaissance veto authority over Palomino's entire Articles of Association. That's a huge sign of Rentec's control. Not only does it have contractual and functional control over the accounts of Palomino, it also now has veto authority over the details of the organization's charter. Mr. Malloy, this was one of the factors that Barclays used to justify the deconsolidation of Palomino in its financial statements in 2009. Is that right?
Yes.
Now, when Barclays deconsolidated Palomino, which means it removed Palomino from its annual financial reports, and when it removed it from its financial statement in 2009, Barclays took the position that Palomino is controlled by Rentec. Barclays' reason for taking this position were laid out in a June 2009 memorandum that Barclays wrote to its own auditor, Price Waterhouse. So if you'll take a look, please, at Exhibit 53. This is a memorandum that was written by Barclays' Structured Capital Markets Group, which was responsible for developing the basket transactions. Now, I reviewed the reasons in depth with the first panel, the reasons given, and the full list is, again, available here for all the reasons that it represented what it did. So I'm just going to summarize that the reasons that Barclays gave to its auditor for wanting to deconsolidate Palomino. Here are the reasons. The trading activities of Palomino are managed solely by Rentec, such that Rentec can obtain the majority of the benefits from Palomino's activities. The prime brokerage accounts are controlled by Rentec. Rentec effectively is entitled to 100% of the benefits from Palomino's trading accounts. Rentec is exposed to 100% of the risks from Palomino's trading accounts. And this is the conclusion, which you can see to that document. It's on the last page. This is the last page. It's under, I don't know if it's the last page, it's E. Oh, it's page 64? Bates, so that's 64 is the Bates number there. See that? Following the proposed amendments to the articles and the entry into the side letter, Rentec controls the major activities of Palomino and is exposed to substantially all significant risks and rewards arising from the activities carried out through the prime brokerage accounts, being the only permitted activities of Palomino. Consequently, Barclays, which is PBPLC, should deconsolidate Palomino from the date these proposed amendments are effective because they give rise to a loss of control. So now you're representing, you being Barclays, representing to your auditor that from the date of those amendments, Barclays no longer controls Palomino. Is that correct? That was the representation in that letter to Barclays' auditor. Is that correct?
Mr. Chairman, I think there's a number of points.
Or did I read it correctly?
You read the statement that's in there, but I think you actually have to look at different aspects of this particular documentation.
Okay.
To put it into context, this is a document between accountants going back and forth over European accounting standards. And if we take some of the components that you talk about where when you mentioned the risks, there's several spots within this documentation that actually highlights that, as I mentioned in my opening statement, that Barclays is exposed to the gap risk. So this is, when we're looking at this particular language, it's from an accounting perspective, Mr. Chairman, that they're starting to talk about the control component. I would observe that control is more of a conclusion. If we go back to the...
Well, what was the conclusion that Barclays gave to its auditor?
This is a conclusion from an accounting standards perspective.
Was it-
Palomino...
You mean it didn't control it? You're saying that it controlled it for accounting purposes, but not for what? For tax purposes?
For...
Is that what it says in here?
Palomino was deconsolidated for accounting purposes.
Yeah.
It was still consolidated, though, for regulatory purposes. So,
Well, let's look at the regulatory purposes.
Mm-hmm.
Look at the statements which you, look at exhibit, if you would, 68. Statement to the SEC.
yep.
Your annual report to the SEC filings, you've excluded Palomino from consolidation because Barclays doesn't direct the financial and operating policies of these entities, or doesn't have a superior economic interest in Palomino, because Barclays either cannot direct the financial and operating policies of Barclays, or on the grounds that another entity has a superior economic interest in Palomino. Now you're talking to the regulator, right? You're saying we're going to deconsolidate, we're not going to consider Palomino part of us anymore. It's excluded from consolidation. This is what you're reporting to the SEC, is that correct? In Exhibit 68, you read that on page 230?
Yes.
These entities are not deemed to be controlled by Barclays, and what's one of the entities? Cayman Islands own Palomino. So now you're talking to the regulators. Was that statement true?
As I understand it, Mr. Chairman, this is an outcome from the analysis that was done on the accounting. So for the accounting standards, under that definition of the accounting standards associated with it, yes. I would point out, though, that...
But yes, what? That the statement was true.
I don't know of any factual inaccuracies in the memo that was submitted to
Well,
PwC.
my question is the representation to the SEC that the entities are not deemed to be controlled by Barclays, was that a true statement to the SEC? That's my question.
Mr. Chairman, I'm not an accountant.
No, I'm asking you whether or not this statement to the SEC was correct. That's all I'm asking. It's not an accounting statement. It's a factual statement that you made to the regulator. These entities now we're talking about Palomino, is not deemed to be controlled by Barclays? That's a very direct question.
I'm sure the statements that we made to the SEC are accurate. I was just pointing out it's from an accounting standard, Mr. Chairman.
So it's accurate for an accounting purpose, but inaccurate for what other purpose?
No, I'm not suggesting that these are inaccurate statements going to our regulators.
Well, you're saying it was accurate here, but it wasn't accurate for some other purpose. So where was it inaccurate?
What I'm pointing out is when you're doing some of these analyses that are going back, when you start talking about some of the language that's associated with it, the language could mean different things to different aspects, one from an accounting perspective, one from a tax perspective.
And so in other words, you're telling you didn't tell the SEC that, hey, we don't control this for SEC purposes, but we're going to claim we control it for tax purposes. Did you tell that to the SEC?
I'm not aware of
Did
exactly.
the SEC refer this to the IRS?
I became aware later that it did, yes.
So take a look at the next statement, Exhibit 68, that's 2010. Same statement, these entities, including Palomino, are not deemed to be controlled by Barclays. 2011, same statement, these entities, again, Palomino, not controlled by Barclays. Year after year, you're representing to the regulator. These entities are not controlled by Barclays. But then it's interesting, you say in Exhibit 68, take a look, if you would, at the 2013 representation to the SEC. You're saying, if you look on third paragraph there under Note 38.
I'm sorry, Mr. Chairman.
Sure,
which page are we on?
Note 38, Exhibit 68. This is now the 2013
Okay.
representation to the SEC. Fiscal year ended December 31st, 2013.
Okay.
Look at the third paragraph. Do you see that? It starts an interest in equity voting rights. You see that paragraph?
I do.
And at the end, it says, however, certain entities are excluded from consolidation because the group does not have exposure to their variable returns. And then it says the following: these entities are managed by external counterparties and consequently are not controlled by the group, not controlled by Barclays. And that's, again, Cayman Islands Registered Palomino Limited. So, again, Barclays doesn't control it, you're representing, but someone else, external counterparty, manages it. Who's that?
I believe what we're referring to here is the structure of the overall option.
No, but
where
who's the
Renaissance-
who's the
Where
external?
Renaissance was the investment manager as part of that. But I think it is also worth pointing out, though, Mr. Chairman, that we talk about this whole concept. Barclays still was 100% owner of Palomino.
Yeah, I know
We
that's
still
right.
did all of the capitalization of Palomino. We managed all of the financing. We took all of the collateral that we had the full rights to use that Renaissance was never even aware of. So I think it's important that you look at different aspects of the overall structure to see who's acting in which capacity.
Yeah, I couldn't agree with you more as to who the beneficial owner was of this account, who got the profits and losses, who made the decisions on what to buy. All of the key indicators of ownership point right to Rentec. In fact, that's the purpose this account was set up, was to service Rentec. And so you can make a claim that you represented that we didn't control it to SEC, but really we still owned it legally. You claim that you're the beneficial owner of that, of Palomino? Beneficial owner?
We are the beneficial owner of the reference accounts and the assets.
No, not the reference account. Are you claiming that you are the beneficial owner of Palomino?
Palomino is a 100% wholly owned subsidiary of Barclays.
Do you claim you're the beneficial owner of the account that Palomino ran, of that basket account? Do you claim to be the beneficial owner of that basket account?
Yes, we're the beneficial owner of the assets in that account.
Okay. Now, for each of the options for more than 10 years, Renaissance used Barclays software system, right?
Yes.
It gave direct access to the stock market. Rentec executed tens of millions of trades per year in Barclays Palomino accounts. Renaissance received the stock dividends from all those trades as part of the option profits. It was charged commissions and trading costs by Barclays for each of the transactions that it executed. It was charged finance fees by the bank to borrow shares for its short-selling activity in the Palomino account. It was charged a financing fee by the bank on the amount that it used for leverage in the account. Renaissance even received the rebates from stock exchanges for the orders using Barclays' execution system that it sent to the stock exchange. Is that true, what I just said?
In general, yes.
Now, when Renaissance sends a marketable order using your software system to the stock market, 30 million, or I guess, 30 million a year between the two banks, about 15 million per bank. It's executed in a microsecond, is it not? In a second or less. Orders are executed
The order,
in microseconds.
right, again, just to maybe back up and explain how it worked.
Okay. And the same was true, Mr. Ramakrishna, for Renaissance activities at Deutsche Bank, is that correct?
Did you say in a microsecond?
Yeah, these orders were executed in microseconds.
Usually, I mean,
There's 15 million of these orders a year at your bank, right?
Yeah. The orders were sent through our slower system initially, which was in the range of a few milliseconds. Microseconds is 1,000 times smaller, so not in that level.
And
Definitely.
who placed the orders?
They were placed by Rentec,
Renaissance,
yes, in Deutsche Bank's name.
in your name. And Mr. Malloy, did Renaissance receive all the profits from the trading reflected in the Palomino accounts when it closed out the account?
Renaissance, via the option, did get the performance of the overall portfolio, yes.
Okay. Was the same true, Mr. Ramakrishna, for Deutsche Bank?
I'm sorry, I think I missed exactly what the,
Okay, let me repeat the question. Did Renaissance receive all the profits from the account which was run by Deutsche Bank? So here we're talking about Deutsche Bank's account, which held the stocks which were directed and ordered by Rentec. Did Rentec have most of the risk for those stocks?
Rentec had the risk up to the premium that they paid for the option.
Exactly.
Beyond that, Deutsche Bank took all the risk.
Yeah, you never took a loss on any of these purchases, did you?
Honestly, Senator, we didn't take a loss on any of these accounts owing to proactive risk management.
I
We
understand
had other
why.
trades.
There were 30 million buys in these two banks, and you guys didn't take a loss on any of those buys, right?
No, we did not take a loss on,
So you have 15 million buys ran through you to this account. Profits and losses all belong to Rentec. They did the ordering, and you guys didn't lose a penny on any of 30 million buys, and that was all Rentec's risk, right?
Senator, there was a lot of careful selection of
I know
which
it was
client
carefully
paid.
done. I'm asking you, did you lose a penny on any of 15 million buys?
No.
Did you lose a penny on any 15 million buys?
no, that's not to say we didn't have risk, though, Mr. Chairman.
I understand the risk that you're claiming. I'm just saying you didn't,
No, we did not.
for 10 years, tens of millions of buys, you didn't lose a penny on any of the buys. I understand the risk you took, which never panned out. You never lost on any of that risk, but nonetheless, that's not my question. Now, Mr. Malloy, isn't it the case that for the options, the cold options that were written on a basket of securities that were held by Palomino, and that Rentec determined the composition of and the overall investment strategy, is that the case? They determined the composition of the basket, the overall investment strategy. Mr. Malloy?
Yes, they made the decisions of what to purchase and sell.
Okay. And they the options were written on the basket of the securities that were held by Palomino. Is that correct?
Yes.
Okay. To both you, Mr. Malloy and Mr. Ramakrishna, your bank's profits from the options came from financing and transaction fees. Is that correct?
Senator, we charged in excess of what we normally charge for financing and transaction fees.
But
So
that's
the
where
profits-
your profits came from.
The revenues came from that, yes.
And Mr. Malloy?
Yes, we also were able to, this particular transaction, we had profits that came from the ability of the use of the collateral.
Right.
We could use that for securities lending and that also was as part of the revenue stream.
Right. Did the banks, either of your banks, from these tens of millions of trades that were executed every year in your accounts for the option basket, and from the billions of dollars of profits earned in those accounts, did your banks receive any of the profits from the trading activity after you deducted what was owed to Renaissance?
No, in the trading activity that occurred, you know, the account would be up or down, losses or gains on any individual day, but Barclays did not receive any of the performance, no.
Is that true? Mr. Ramakrishna, with your bank?
Chairman, sir,
Is what he said true with your bank?
the payoff of the option was indeed the.
No, I'm just
payoff.
asking you whether, if you can't answer, it's okay. But what he's just said, is that true with Deutsche Bank?
I'd like to just qualify it with one extra statement, which is that, for instance, when you have a trade from a customer, you may have crossing profits because you are able to cross internally. That sort of profit wouldn't be recognized as Renaissance's profit. That would be Deutsche Bank's profit.
Yeah.
But otherwise,
Otherwise-
the account determined what the option value was, which is what Renaissance got back.
Now, to both of you, Renaissance is using the bank's trading execution system to place and execute for itself, by itself, several 100,000 trades a day that go into the basket account. The banks don't even get involved. Renaissance has direct access to Barclays and Deutsche Bank's trading platforms to place orders. These orders go out directly to the exchanges in microseconds or seconds. If they're marketable orders, they get executed immediately. Renaissance was purportedly your investment advisor, but they were given by contract discretionary authority to execute trades, so they could execute trades, which they did by the millions in the bank's Palomino accounts and the bank's account, without prior approval of the bank. Is that correct, Mr. Malloy? They could execute the trades without prior approval.
No.
They could not. So
No.
did you approve 15 million trades during these years?
No, what we did is you have to have a process that's put in place.
You
that did-
approved the process.
No, if I could.
Sure.
There's actually a process that actually goes in place. As you rightly pointed out, there's a lot of transactions that are going through there. So your ability to look at that, you look at the exception-based processes. So
Right.
what we had in our particular systems is in this particular transaction, there was a disproportion, and the majority of the trading activity had to be done through our infrastructure, so we had control of that. We have the ability to block that on a name-by-name basis. We have the ability to put that in a restriction as far as the overall notionals, and we monitored the basket as it was going intraday. And that's not to say that on the next day, even though it's going from in a fashion of quick execution after the fact, and we've done that on several times where we did not like a particular security either through restriction and the like and asked them to take it out.
All right, how many times did that happen?
On the restrictions of names, that's on a daily basis.
No, how many times did you veto anything in their purchases?
From an execution point of view, I don't recall. It was after the fact, Mr. Chairman.
All right. How about the Deutsche Bank?
Senator, the way in which Renaissance traded through us, given that they're a technologically forward organization, we didn't intercept every single trade and approve or disapprove it. We had very strict guidelines in place for the portfolio composition, diversity, liquidity, and and the concentrations in various names. Plus, we had a restricted list. All this was supplied to them at an updated point of time, several times a day, and they'd have to conform to those restrictions. So we didn't at any point actually go back and revisit trades because we didn't have to. Those trades would be banned by definition.
All right. You had already set what the conditions were, but 30 million trades went through without you stopping any of them from going through.
We had exception policies in place, basically, which would basically make sure that that trades that shouldn't go through did not go through.
Okay. And so you had about 15 million trades that went through without exception. Is that correct?
We had lots of trades that went through after they passed the vetting.
How many trades were stopped by your guidelines?
Given that the restrictions put in place prevented trades that would have that should not have gone through, all I can tell you is that Renaissance took great pains to make sure that we had no exceptions, and we had very few exceptions. I can't think of any in my own tenure there.
So of the 15 million trades in your bank, the guidelines that did not stop any of those trades. Within your guidelines, they made the decision, they made the purchases and sales. Is that correct?
Exactly. They never violated the guidelines,
All right.
yes.
So your guidelines never stopped any of these millions and millions of decisions that they made. Is that correct? Is that true also with Barclays, Mr. Malloy?
What I would say, Mr. Chairman, is we actually stopped the transactions that didn't fit into the guidelines ahead of time.
Yeah. Well, in other words, you set guidelines in
No, but we restrict the names before they even got into execution,
it. And how many times did that happen over the years?
every day.
So you actually stopped them from making purchases every day.
We would block in our systems.
Your system blocked, you say?
Yes.
Okay. If it was inside of the investment guidelines, all of the trades would go through, is that correct?
If it was inside the investment guidelines, yes.
Okay. And you would
So
agree
as a
with...
normal course of business, because it reduced our risk associated with
I
the
understand.
hedge.
I understand.
Yeah.
But you had agreed on what those guidelines were?
Yes.
Okay. So they had agreed to guidelines, and they lived by the guidelines, and if they didn't, the purchase would have been caught.
I'm sorry,
The purchase would have been prevented. The transaction would have been prevented if it violated the guidelines.
yes.
And would that be by their own algorithm or something you put in place?
It depends upon what aspect of the investment manager that they're referring to.
Did they basically buy these 15 million shares that went through your system through an algorithm?
As I understand it, yes.
Is that true with you too, Mr. Ramakrishna?
I believe that they used the algorithm, yes. I don't
Was
know
that
what-
their algorithm?
The algorithm that they used decided what they wanted to buy and sell.
Whose algorithm was it?
It was presumably a Renaissance's algorithm.
Do you know whose algorithm it was?
It was Renaissance, as I understand it, yeah.
Did they share their algorithm with you, by the way?
They have not.
Sadly, no.
Decidedly not.
No, they
Sadly
haven't.
not.
No, they haven't.
Here you go.
Thank you, Mr. Chairman. Apologize for missing the earlier panel and the testimony here. We're obviously drilling down in some, fairly detailed levels. And I'd kind of like to just pull back a little bit and try and get a little bit simpler understanding of something that is probably pretty complex. But to follow up on the chairman's questioning there in terms of basically hiring a manager to manage a portfolio within the banks, do you have examples of other managers that you use similarly to manage certain funds in your banks, Mr. Malloy?
In this particular transaction, we only had one counterparty that we did this in, and within the prime brokerage piece, no, I'm not aware of another example of that.
No, I'm talking about just other managers that do other mutual funds that your bank holds for your customers. I mean, is there another? Do you hire another manager to do something similar? I'm not saying really high frequency trading like this, based on an algorithm, but just a manager to manage a portfolio of stocks for your customers.
I really couldn't speak across the bank. I wouldn't be surprised if there was one, but I'm just not aware of one.
Mr.
Senator.
Ramakrishna, does Does Deutsche Bank have something similar to that you can point
Senator,
to?
in the asset management division, we definitely have external managers who are often hired to manage portfolios for customers. We have a couple of external managers on our own platform, which are going to be phased out very, very soon, which manage money for us.
Is there, other than the frequency of the trades or the number of stocks they buy and sell, is there any real difference between how your relationship is with those managers versus with Renaissance?
They also run portfolios of similar, if maybe a little smaller size, with a large number of names. And they may not use the same algorithms or the same frequency of trading, but they do trade a lot.
But again, your guidelines in terms of how you deal with those managers, is it similar or identical? In other words, you hire them to manage a particular fund that you make available to a potential customer, and you're selling a mutual fund that could be bought and sold with a capital gain attached to it?
I would characterize the rules we used for Renaissance as much tighter. We had constraints on liquidity, concentration, size of position, which stocks they could actually trade, sector concentrations, country concentrations that we'd never put on any other manager, because at some level, that's their strategy, and if they want to run it, it's fine. The reason we ran these portfolios this way was because of the risk we ran in this portfolio.
But again, the guidelines in terms of how you manage your manager, the different guidelines, but is it similar? I mean, you have guidelines that you work with the manager to manage your portfolio of stocks or bonds or options or whatever type of investment vehicle there is. I mean, again, I'm just trying to figure out if there's something similar to Renaissance in terms of structure, not necessarily in terms of frequency of trade.
Not really, no.
So this is pretty unique.
It is pretty unique, yes.
As I'm studying this and getting prepared for this, what this appears to be is a question of form over substance. I mean, is that a basically true statement, Mr. Malloy? I mean, the form of how you've structured this deal versus the actual substance of what's happening?
Again, the way in which this is structured is as an option and has those features in it. I don't know if I actually understand
I mean,
the question.
Isn't that, let me just ask, to what extent has this been adjudicated in any kind of tax court or through the IRS? I mean, I've seen some memorandums passed. I mean, is this really being looked at? Do you think this is going to eventually go before tax court?
As I understand it, there's an ongoing, it's a better question, obviously, for probably Renaissance, but
Okay, sir.
Thank you, Senator. Yes, as I said in my opening statement, the IRS has been, we've been in conversation with the IRS for about 6 years now on this. They've had full transparency. They understand the structure very well, and we're in the midst of that process. We're hopefully going into the appellate level of the IRS shortly.
So has this gone before tax court at all? You're saying the appellate level?
Not
You're
yet.
just
No.
working through the...
We're still working through the administrative process.
Okay. Mr. Malloy, earlier questioning by the chairman was really talking about control. There's different levels of control based on tax versus accounting standards versus potentially SEC. Michael, how many different bodies do you have to comply with in terms of determining whether, for example, Barclays would control a particular entity?
I think it really comes down to what aspect of the transaction you're going to. From my lens, when I think about control, it's who ultimately has, who is the beneficial owner of the assets and whether you can actually use the assets.
No, the point I'm trying to make is, back in my former life, grappling with similar different issues, there are criteria to determine whether the IRS is going to take a look at this as a controlled entity, or versus whether accounting standards determine that.
Right.
And they're not always the same, correct?
Correct, although you have the advantage there. I'm neither an attorney or a tax attorney, but as I understand it, yes.
Mr. Ramakrishna, can you speak to that? I mean, how many different bodies do you report to that you have to try and comply with in terms of determining whether or not a particular group is under control of your bank?
Senator, as a risk manager and the person who would take the first hit if there were a loss in this portfolio, it was very clear to me that we had ultimate control because we were the ones who were going to bear the brunt of a catastrophic loss. We did give the investor permission to trade, the manager, the investment manager, permission to trade in the account. And we had an option whose delta was essentially managed by this investment manager. But it was very, very clear to me that if there was a loss, it would be on my head and on Deutsche Bank's head, not on the investor's court. So in my mind, at least, control was very, very settled. I don't know the legal ramifications of what control means for other organizations. I'm sure there are accounting and tax standards. I don't know them, though.
Okay. Mr. Silber, do you know the point I'm trying to make here? I'm not really, right, I'm not trying to judge whether or not this was a controlled entity. I'm just trying to point out, in trying to comply with whether it's the tax authority or whether it's SEC or whether it's, you know, just your basic accounting standards. I mean, how many different bodies are you trying, you provide different standards, different criteria for determining, to make these judgments, whether something is truly an option or whether it's under your control or, you know, understand the point I'm making?
Yes, I understand, Senator. We are nowhere near as diverse an entity as either of the banks here, but we ourselves are subject to multiple levels of regulatory review and filings, many of which, from the IRS, the SEC, we're regulated by the CFTC. We have ongoing filings, many of which have different definitions. You used the example of control. That is important in some of the filings and not in the others. Even something as simple as assets under management under either our U.S., generally Canada accounting statements filings versus Form PF, which the SEC, we now file with the SEC regularly. Definitions of similar words will differ across for different purposes for different agencies. Tax standards usually are different than accounting standards. Those are the ones that I'm most familiar with. But we have a variety of reporting regimes that we file under, and the definitions are not always consistent.
So suffice to say, it's very difficult to comply.
We do our best.
With all the different standards, with all the people who report to.
I wouldn't say it's difficult. We put a lot of time into it. We do comply, but sometimes it's very hard to compare two set of filings and try and get them to reconcile. They may be using different definitions. So, as I say, I use the example of, assets under management, for example, should be, fairly straightforward English. Different purposes will give different results, and both will be correct under the applicable rules.
So, I'm really kind of trying to drill down in terms of what's the appropriateness of these transactions, of this relationship. It really, you're going to have to, if it's a tax issue, you really have to go through the tax authorities and take a look at exactly their rules versus if we're going through accounting standards and reporting, you're going to have to go through the SEC and figure out.
Yes.
And it's a little more difficult in a setting like this where we're talking sometimes across purposes about different standards between different agencies. I mean, is that basically correct?
Yes, I believe so, Senator.
Okay. I have no further questions, Mr. Chairman.
Thank you.
Mr. Ramakrishna, I think you just said that Deutsche Bank gave permission to Renaissance to trade in Deutsche Bank's accounts. Is that correct?
Yes,
You just said that. You gave them the right to execute
in Deutsche Bank's name, yes.
in your name.
In Deutsche Bank's name, yes.
And is it not true that they had discretionary, they being Rentec had discretion, total discretion, full discretion and authority without obtaining your prior approval to manage the investment and the trading of the accounts? Is that true? Both of you?
I'll take it first, sir. Given the constraints we had placed on them, which were maintained on their systems electronically, under those constraints, yes.
All right. The constraints were agreed to, and then within those constraints, Deutsche Bank had the full discretion and authority without obtaining your prior approval to manage the investment and trading of the accounts. Is that correct?
Yes, sir, under those constraints, yes.
Is that also true for Barclays?
Subject to the investment management agreement, but I.
Of course.
Yeah, I wouldn't characterize it though as unfettered. We looked at those transactions, we monitored it in real time.
How about full discretion?
I wouldn't say full because it was subject to restrictions under the investment.
You would or
management
would
agreement.
not?
I would say it was restricted under the investment management.
Did they have
If
full, would the word full discretion be accurate?
Subject to the investment management agreement, they had discretion.
Full discretion?
Not unfettered discretion, Mr.
I'm
Chairman.
just asking you, did they have full discretion or not within the agreement that you reached?
If they
with it?
stayed within the guidelines, they could make the transactions. They had full discretion to
That's what I'm just.
to deploy the
I asked you 3
portfolio.
times, did they have full discretion within those guidelines? And
Yes.
you hesitated to say full discretion.
The only reason I hesitated is because we do have some restrictions within there, and I can step in. That's my only reason
Other
for
than that, they had to
hesitation.
operate within the guidelines, but
Yes.
other than that, they could buy and sell anything they wanted, right?
Yes.
And they did 15 million times, right?
There was a lot of activity that went through the accounts, yes.
Okay, and that was within the guidelines. They had full discretion and authority. Is that right? Without your prior approval, within those guidelines
Within the guidelines,
that you two had agreed to?
yes.
Okay, is that true with your bank, Mr.
Senator, I
Ramakrishna?
already agreed, yes.
Okay. Now, if they operated within those guidelines that they had agreed to with you, they could, since they had full discretion, providing they operated within those agreed-upon guidelines, the decisions as to what to buy and sell were theirs. Is that correct, Mr. Malloy?
Yes.
Mr. Ramakrishna?
Yes, sir.
Within those guidelines, I don't know what percentage of securities they could buy and sell, but I assume it's the vast, vast majority, but nonetheless, whatever that is, it's probably tens of thousands, hundreds of thousands that their algorithm could choose. Within those guidelines, that decision was theirs. Is that correct?
Yes, sir, about 6,000 of them, 6,000 securities.
6,000?
Securities, roughly, yeah.
Yes.
Okay. So within those guidelines, among those 6,000 securities, it was their discretion, and they were not making recommendations to you then, were they? Within those guidelines?
They would make the recommendations and then execute on our behalf to hedge the.
But wait a minute, I thought they had full discretion within those guidelines.
They have the full discretion to make
Buy and sell within those guidelines,
to buy and sell within the guidelines.
that they had agreed to.
Yeah.
Okay. They weren't within those guidelines when they made those decisions using your platform. That was not a recommendation to you. They made the decision within those guidelines, within that number of 6,000 securities or whatever it was. That was their discretion, their decision. Is that correct?
Yes. We still had the legal right, although as we discussed,
You didn't exercise it.
we didn't exercise it till after the fact in the instances, yeah.
Okay. Silver, you've been listening to this testimony about when you operated within those guidelines that you had agreed to, that you had full discretion under the contracts. Is that correct?
Within the guidelines, yes.
And if you operated within the guidelines, you considered that decision as to what to buy and sell was yours. Is that you had full discretion?
Yes.
And your algorithm that you put together would pick and choose. Is that correct?
It was put together by our group.
By your group?
Yes.
The algorithm would pick and choose
That's correct.
among those, what, 6,000? Is that about what it was?
Approximately.
And within those guidelines, it wasn't for you to make a recommendation, it was for you to make a decision as to what to buy. Is that not true? Your algorithm?
We had the authority to make the decisions for the reference basket, which was the important criteria for our options. At the same time, we were making the recommendations, which as we've heard, it was almost always executed for the hedge account for the banks.
So if you operated within the guidelines,
Yes, then it would be,
then it was your decision,
for the initial investment, yes.
the initial investment. What does that mean?
It meant that, that the banks, in either case, had the ability, I don't know if they ever exercised it, to have changed delevered, I'm sorry, excuse me, wrong language, to remove their hedge or to hedge in a different manner. The purpose of our exercise.
They had the authority, but they never exercised it. Within those guidelines that you had agreed to, there may have been 6,000 securities that you had the right, the discretion to buy and sell. Within those guidelines, that,
They were placed into the account.
and the decision was yours, within those guidelines.
Our firms, yes.
Your firms, of course.
Yes,
Okay. So they're not a recommendation to them within those guidelines. Would you agree?
correct.
Okay. Mr. Malloy, take a look, please, at Exhibit 36. This is a product proposal for Project Colt, which is the project we're talking about. That's the basket option project. This was dated May 28th, 2002. Your name is on it, so I assume you're familiar with it. And if you look at page 46, if you look at that Bates number, the numbers 4-6,
Yes.
at the bottom, let me read this to you. Colt, that's what we're talking about here, is targeted, so this is your product proposal, 2002. It's targeted at those funds with a high proportion of U.S. individual investors, stable year-on-year returns, and strategies involving short-term trading. This gives rise to significant short-term capital gains for the investors, regardless of whether or not they are invested in the fund for shorter or longer term. Then it says on page 4, Colt provides an after-tax benefit to these investors through the conversion of their return from the fund from short-term capital gains, taxed at 39.6%, to long-term capital gains, taxed at 20%. Did I read that right?
Yes, you did.
Now, was this a product being proposed for Renaissance?
The initial structure for Colt, yes, the initial and subsequently only client was Renaissance.
All right. So what you were, in your proposal, saying is that this proposal had an after-tax benefit through a conversion of their return from the fund from short-term capital gains taxed at 39.6% to long-term capital gains taxed at 20%. That was obviously an important part of your proposal. Well, Mr. Silber? Back in 2002, this is a pretty important part of their proposal. Hey, this is for Renaissance. Hey, we can convert. It's like magic. Short-term into long-term. You still say that that wasn't something that crossed your mind back in 2002?
I'm not saying that it didn't cross our mind. Once we had initiated the structure with Deutsche Bank, we came to realize that there had the potential for a favorable tax treatment. So we certainly were aware of it, but I can't speak to this internal Barclays document.
Wasn't this part of the proposal that was made to you?
No, I've never seen this.
No, I'm not saying this in Britain. When you were discussing this with Barclays, are you saying that they never mentioned to you the tax benefits in 2002?
Actually, I believe we actually proposed a structure of this to Barclays. They didn't market it to us.
Okay.
Deutsche Bank did market the structure to us. It was a product that they had already used, and they had not used the tax benefits as a selling point at all.
Deutsche Bank never did.
No.
And Barclays was marketing this to you, weren't they?
We actually had suggested it to them, so
After you suggested it to them, because you already
Well,
had one with
that-
Deutsche Bank, then they somehow, where did they get this language from?
I don't know.
You don't know. So this was never discussed with Barclays,
Not to my knowledge, no.
okay? Barclays, did you ever discuss this with Renaissance? It was in your proposal. Did you ever discuss the tax benefits with Renaissance in 2002?
Yeah, I'll answer the question two ways, Mr. Chairman. I wasn't personally involved with covering the account at that particular time, but as you can, so I'm not sure exactly what the first exchange was. I subsequently did cover the account from a relationship perspective. But it was clear within the bank, though, that there was a tax benefit along with other benefits in the structure.
So take a look, if you would, now at Exhibit 42. This is a product approval memorandum for the same basket option. On page 3,
163?
no, page,
Oh,
this is Exhibit 42, we're looking at page 3,
okay.
under the term economics and economic drivers. Fund benefit. U.S. individual investors of the fund would obtain a post-tax benefit if the call option is exercised after 12 months, because all of the gain on the call option would be treated as a long-term gain for U.S. tax purposes and would therefore be taxed at 15% as opposed to 35%. Does that look familiar?
I'm not familiar with this particular document.
But is this a Barclays document?
Yes, appears to be yes.
And take a look, please, at Exhibit 37. That Barclays wrote to its regulator. And this is on page 1 on background. Right in the middle of page 1. This transaction is designed to provide hedge funds with a tax-effective means of undertaking the business, and for Barclays, it would generate both a structuring fee and an additional volume for the prime brokerage business. So you told your regulator back in 2002, this was designed to provide hedge funds with a tax-effective means.
We were very transparent in this particular
You
transaction.
were very aware of it.
Very concerned, and one of the advantages, there was a tax advantage along with others,
Right.
yes.
Now, Mr. Ramakrishna, when MAPS was restructured, when your basket, your structure was restructured in 2008, were you concerned, was Deutsche Bank concerned that the old structure, the MAP structure, would not be respected as a derivative, or more specifically, as an option for tax purposes? Was that one of your concerns in 2008?
Mr. Chairman, my initial concern was purely devoted to risk issues.
Okay?
There was a parallel conversation going on between lawyers in tax and legal, which I wasn't privy to, which I gather revolved around restructuring the transaction. It's probably a
Was there a question in these conversations between your tax people, with your tax people, that there was a concern that the old maps, the old approach might not be respected as a derivative, or might not be respected as an option for tax purposes? Was that a concern?
I have no idea, Mr.
You
Chairman.
know, okay. But if it weren't respected as a derivative, then it would lose the tax benefits that was offered. Is that correct?
I presume so, yes.
And then, okay, and that benefit was turning short-term capital gains into long-term capital gains. Is that true? That's what the tax benefit was.
That was a tax benefit, yes, sir.
And are you saying, again, make sure I understand your answer, that one of the reasons that this was restructured was to address the concern over the tax benefit, that it was one of the reasons? Is that what you said? Or you don't know?
I don't know. The reason I was involved was because of a risk reason that I raised.
All right, but you heard conversation about concerns as to whether or not there would be a tax benefit under the old structure. You heard conversations about that?
Certainly not, Senator.
You never
I was not
did.
involved in that.
Okay? Did you ever have conversations with a man named Broeksmit?
Yes, sir. Did.
And in that conversation, did you indicate to him that tax reasons were one of the reasons for this structure?
Senator, I had several conversations.
No, in one of the conversations.
Yeah. The conversation I had was mostly about explaining the risk issues.
I understand. That's not my question.
Yes, in the course of the conversation,
Did you tell him that one of the concerns was whether or not there'd be a tax benefit under the old structure? Did you tell him that?
in the conversation, he mentioned that as a benefit, and I agreed with him, and I said there were other reasons too.
That's fine. You agreed with him in that conversation.
Yes, sir, it was one part of a large
A
conversation.
minute ago, you said you never heard of that.
I think you had asked me if I had heard anybody from tax and legal talk about it. I didn't do that.
Oh,
This was also a
well,
conversation.
who is Mr. Broeksmith with?
He was head of risk and optimization of
So you
portfolio.
heard from someone in your own division that there was a concern about whether the tax benefit would really be there under the old structure?
Mr. Brookschmidt was not in charge of.
Not in charge of, what division was he with?
He was at the central level, head of risk across the bank,
Fine,
across the corporate bank.
fine. Did you hear from him that there was a concern about whether the tax benefit would be there under the old structure?
I didn't hear from him that he was concerned about tax risk.
Well, you had a conversation, you said, with him, in which the question as to whether the tax benefit is solid in the old structure.
No, that was not the conversation I had. It was a conversation which said, what are the benefits of the transaction, at which point I gave him the benefits, and he mentioned tax benefit as one of them.
So you heard him say about,
He did say tax benefit was one of the benefits, yes. He knew as well as I did.
thank you, all four of you. Appreciate your being here, your cooperation with our subcommittee, and this panel is excused. Yeah. Let me now call our last panel of witnesses for today's hearing. Gerald, is it LaRocca or LaRocca? LaRocca, Gerard. Gerard LaRocca, the Chief Administrative Officer, Americas for Barclays, Chief Executive Officer for Barclays Capital Inc. in New York. Mr. Barry Bassano, did I pronounce your name correctly? President and Managing Director of Deutsche Bank Securities and co-head of Global Prime Finance in New York. And Peter Brown, the co-chief executive officer and co-president of Renaissance Technologies in East Setauket, New York. We thank you for being with us today, and we also thank you and those with whom you work for your cooperation with this subcommittee. Pursuant to Rule 6, all the witnesses who testify must be sworn before this subcommittee, so please stand and raise your right hand. Do you swear that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth, so help you God? I do. Were you here before? Are you familiar with our timing system that we've been using? Well, if not, let me repeat it. About a minute before a red light comes on, you're going to see the lights change from green to yellow to give you a chance to conclude your remarks. Your written testimony is going to be printed in the record in its entirety. Please try to limit your oral testimony to no more than 7 minutes. Mr. LaRocca, let me call on you first.
Good afternoon, Senator.
Good afternoon.
I am Gerard LaRocca, and I serve as the America's Chief Administrative Officer of Barclays Bank. You've asked us to assist the subcommittee in its review of certain issues related to the Colt transaction. As with other complex transactions, from the outset of Colt, the bank undertook a comprehensive review and approvals process to ensure that the transaction received proper scrutiny. This included review by the bank's tax, regulatory, risk, and legal departments, as well as a review by at least 7 different law firms over the life of the transaction. Barclays disclosed its participation in the transaction to our auditors and regulators here in the United States and the UK. We did not take this matter lightly and were ultimately comfortable in engaging in the transaction. A question raised by the subcommittee seems to be, what is the proper tax rate to apply to profits earned by Renaissance through the exercise of its options? This is a matter to be handled by Renaissance as a taxpayer and the IRS. It is my understanding that the question has not been answered definitively. You've asked me to discuss the impact of a 2010 IRS advisory memorandum known as a GLAM, including the bank's decision last year to change the tenor of the options going forward. All of this did not occur in a vacuum. Like other financial institutions, Barclays has faced numerous challenges in recent years. Our bank has endeavored to meet these challenges head-on, and at times resolving them has resulted in significant changes, both in process and in personnel at the bank. Today we have new leadership and feel strongly we are moving in the right direction, transforming the way we do business. In 2012, Barclays had launched Project Mango, an internal review of our investment banking operations, and also commissioned Sir Anthony Sauls to conduct an independent review of Barclays. Finally, Barclays embarked on the Transform program, an internal review aimed at establishing the conditions necessary for the bank's long-term success, including the implementation of the 34-point roadmap for change detailed in the Sauls report. As part of Transform, the bank adopted 5 overarching tax principles that we now apply to all transactions. These are: transactions must support genuine commercial activity. 2, they must comply with generally accepted custom and practice. 3, they must be of a type that taxing authorities would expect. 4, they must only involve financially sophisticated customers. And 5, transactions must be consistent with our purpose and values. It is against this backdrop that we considered what impact, if any, the GLAM should have on our participation in the Cult transaction. In December 2010, Renaissance made a routine request to enter into a new option. In light of the GLAM's recent publication and prior to moving forward, we consulted with Renaissance and again with our own legal advisors regarding the impact of the GLAM. After extensive internal consideration and consultation with external advisors, Barclays approved the issuance of a new option. We agreed to continue to monitor relevant IRS announcements going forward. In February 2013, the bank issued its new tax principles and undertook a review of all existing transactions, including Cult. As noted, one of the principles provides that Barclays will not structure transactions of a different type than tax authorities would expect. The end result of our review was a decision that, going forward, we would limit the tenor of any new Cult options to a period of 11 months. The IRS had not made a final determination as to the appropriate tax treatment. However, the bank made a proactive and voluntary choice to shorten these options to ensure we met the tax authorities' expectations. This was a decision that brought the transaction into conformity with our newly adopted tax principles. By doing this, the bank's committed not only to following specifically applicable laws, but also to refrain from engaging in transactions that, while legal, might not meet the expectations of the relevant tax authorities. Therefore, any questions the subcommittee may have about these transactions do not relate to the Barclays of today or the Barclays of the future. These are transactions from the past about which we are awaiting a final determination as to the proper tax treatment. Thank you for the opportunity to provide this testimony. I look forward to answering the subcommittee's questions.
Thank you very much, Mr. Bassano.
Good afternoon, Chairman Levin.
Good afternoon.
My name is Barry Bassano. I'm currently president of Deutsche Bank Securities, Inc., and co-head of our global prime finance business. After growing up in a suburb of Detroit, I am coming east for college. I'm now based in the New York office of Deutsche Bank, and have worked there for approximately 12 years. My colleague Satish Ramakrishnan has already discussed some of the specific features of our MAPS options. I want to provide you with an overview of the product and Deutsche Bank's involvement with it. I note that Mr. Ramakrishnan and I have submitted written testimony, which I request be entered into the record, and you can find a more comprehensive discussion of these subjects in the written testimony.
It will be made part of the record.
Thank you. Derivative financial instruments are a critical component of global finance, as they allow participants to alter risk and the distribution of returns relative to holding the underlying investments. Deutsche Bank strongly believes that it acted at all times responsibly, indeed proactively, in its ongoing consideration of MAPS in the light of the evolving views regarding the regulatory landscape surrounding derivative products, and that its conduct demonstrates a strong commitment to be well within the bounds of the law. MAPS was not a tax-motivated product. It provided clients with significant non-tax advantages as compared with other products. Let me briefly discuss here what I view as the three most significant of those advantages. First, Deutsche Bank was comfortable providing the option buyer with greater leverage at the fund level than it would have allowed in a traditional prime brokerage relationship. Second, the MAPS option limited the client's downside risk, the premium it paid to purchase the option. Third, the client could pursue its trading strategy anonymously because any market transactions associated with the trading strategy were made in Deutsche Bank's name. On the bank side of the equation, MAPS provided the bank with greater visibility, risk controls, and operational protections relating to the underlying trading activity than existed for a prime brokerage account. The bank imposed significant constraints on the investment advisor's strategy, requiring the advisor to follow a defined and balanced investment strategy. The bank also had specific contractual rights to require the investment advisor to reduce its leverage and for DB to take over the management of the portfolio and to assume control and liquidate the positions being traded by the investment advisor if the value of the portfolio fell beneath certain benchmarks. The bank owned the securities in its own account, had complete visibility, ownership rights, and controls over that account, and the bank earned a premium for selling the option. The MAPS product thus involves symmetric and economic exchange of risks and benefit for both the bank and its client. I understand the IRS expressed concerns with particular type of barrier option contract and the potential for associated long-term capital gain treatment is set forth in the IRS General Legal Advice Memorandum, or GLAM, issued November 12, 2010. Importantly, in 2010, Deutsche Bank was not entering into any barrier option contracts as described in the GLAM. Indeed, the bank had ceased offering a product based on agreements similar to the ones described in 2008, when in consultation with outside counsel, we independently restructured our MAPS product. Despite having no knowledge of any IRS intention to release a GLAM, Deutsche Bank proactively addressed virtually every factor considered in the GLAM approximately 2 years before its issuance. The restructured Deutsche Bank product is now referred to as new MAPS. It's important to note the limited scope and use of the new MAPS at Deutsche Bank. From 2008 through today, Deutsche Bank has entered into new MAPS options with only one client, Moselle LP, a Rentec affiliate. And even with that one client, Deutsche Bank entered into only one long-term option following the IRS issuance of the GLAM. That option was negotiated prior to the GLAM and entered into on the business day following its issuance, and only after Deutsche Bank conferred with outside counsel to confirm that new MAPS was not the same structure as the product described. Indeed, and importantly, shortly after the issuance of the GLAM, Deutsche Bank reassessed its participation in barrier option contracts. Despite its belief that new MAPS was in compliance with applicable laws and regulations, Deutsche Bank decided it did not wish to risk being associated with any controversy over the tax treatment of MAPS. Therefore, it decided to cease entering into any new MAPS transactions with a duration of more than 1 year. Deutsche Bank has affirmatively and proactively undertaken steps to ensure compliance with the applicable tax, securities laws, and regulations. While the subcommittee has raised important questions about tax policy in this area, we did our best at all times to ensure compliance with the laws and regulations as written and understood by the subject matter experts at the time. I do note that as widely accepted principle, one the subcommittee report acknowledges, that tax consequences differ amongst various financial instruments. New MAPS, which is an option, was treated by Deutsche Bank in accordance with the tax rules relating to financial derivatives at all times. In sum, with respect to MAPS, Deutsche Bank initiated steps to ensure that its conduct is well within the boundaries set by applicable legal requirements. As of today, neither the IRS nor any court or regulator has found that a new MAPS option, or indeed any Deutsche Bank MAPS option, did not qualify as a derivative for tax, securities, or any other purpose. Deutsche Bank believes strongly that it acted appropriately in entering the new MAPS options when it did. It acted conservatively and responsibly when it decided to stop entering them for business reasons after the issuance of the GLAM. Thank you for this opportunity to speak to you today, and I look forward to answering your questions.
Thank you very much, Mr. Brown.
Good afternoon, Chairman Levin.
Good afternoon.
My name is Peter Brown. I am the co-CEO of Renaissance Technologies, a company that manages investment portfolios with computer programs that are based on complex models of the financial markets. As my colleague Mark Silber discussed in his testimony, barrier options have been extremely important to Renaissance's business objectives by providing our fund with both leverage and loss protection. These go hand in hand because when trading with leverage, a single mistake can be disastrous for our firm. On an unlevered basis, our models would produce modest returns with very low volatility. Therefore, we can responsibly increase our leverage to produce stronger returns. But in so doing, we must protect ourselves from the catastrophic losses that might occur should we encounter a black swan event outside of our previous experience. The world is littered with financial institutions that have failed after putting too much trust in their models, institutions that did not account for the unknown unknowns. We are determined that Renaissance not suffer such a demise. The barrier options we use provide precisely the protection we need. While we have been well aware of black swan risk since long-term capital management collapsed in 1998, for me personally, the wake-up call came on March 13th, 2000. Up to that point, our models had been performing exceptionally well. Then the dot-com bubble burst, and in a very short period, we took very large losses. We worked nonstop for days trying to understand where things had gone wrong. It turned out that we had positions in NASDAQ stocks which our models thought were hedged by positions in NYSE stocks. It just never occurred to us or to our models that these markets could diverge so rapidly. Not having slept for days and being incredibly distraught by the losses, I offered to resign, but my boss at the time rejected my offer, telling me, "You are now far more valuable because you now know never to put your full faith in a model." 6 months later, we entered into our first barrier option. Not only do these options protect us from model failures, they also protect us from programming errors like the one that led to the demise of Knight Capital in 2012. If we did not have loss protection, then with over 1 million lines of code in our system, we too could face the risk of massive losses from a simple software bug. I have not yet had the opportunity to review your staff's report as closely as I would like. I appreciate the time it has taken to prepare the policy issues it raises. But I will note that I was surprised to see the report characterize the risk from which these options protect us as, quote, small, unquote, apparently because of our historical track record. I've worked with extraordinary scientists my entire career, building large and complicated models that are embedded in large and complicated computer programs. If there's one lesson I've learned, it's that models and computer programs can go horribly wrong. Mortgage models at Fannie Mae and investment banks had spectacular 50-year track records until the 2008 subprime crisis. For 35 years, money market funds were considered risk-free until the reserve primary fund broke the buck. The list goes on and on. The single biggest mistake we can make is to be so confident in our models that we have no fear of the risk we didn't see coming. That is why loss protection is so important to us. We understand there's an active debate on how best to reform the tax code, and the proposal has been made to mark all derivatives to market and to tax all capital gains at the same rate. I will only point out that if there were no rate differential between long-term and short-term capital gains, the tax code would be far simpler, far more certain, and far more fair. I want to thank you for the opportunity to speak on behalf of Renaissance, and I'm happy to answer any questions you may have.
Thank you very much, Mr. Brown. Mr. LaRocca, would you please take a look at Exhibit 53? Thank you. This is the document we've been talking about this morning. It's the representation that Barclays made in 2009 to PricewaterhouseCoopers, PwC. It's an independent auditor. And the representation was here, if you look near the bottom of page 64, those are the last two letters and the Bates numbers. The conclusion is that Rentec controls the major activities of Palomino and is exposed to substantially all significant risks and rewards. Was that statement true?
I see the language, Senator. There is qualifying language in the PwC memo.
Right.
You know,
But I mean, it doesn't change that conclusion. This is the conclusion. You've got all the qualifiers in advance, ahead of the conclusion, and then it says here, Rentec controls the major activities of Palomino. Now, Palomino is an entity that you guys created, and
it controls the trading activities, Senator.
it says it controls the major activities.
I know what it says, Senator, but it controls the trading activities. The securities lending is controlled by Barclays. The financing is controlled by Barclays. They
But
control.
the major
They,
activity.
they did control a major activity. That was
That's all
their
I'm
role,
sa-
that
that's
was
all
their
I'm
role
saying.
as investment manager, Senator.
Right, okay, so they control the major activities. This is what was represented to PwC. It's exposed to substantially all significant risks. So is that true?
Up to the premium, Senator.
No, I'm just saying it's exposed to substantially all significant risks. I know there was a risk after the premium was used. We know that. It never was reached, but we know what the risk was. In 10 years, it never was reached, but still, theoretically, it could be reached, and you guys protected against even that possibility. That's okay. You got a right to protect yourself. The question here is, when you tell your auditor that substantially all significant risks and rewards arising from the activities are Rentex, but my question is, was that true? That's my question.
Senator, it is true that Rentec controlled the trading activities and controlled the substantial risk. That's why we were able to deconsolidate Palomino,
It
Senator.
wasn't controlled the substantial risk. It was exposed to substantially all significant risks. That's what was written. Was that true?
With the exception of gap risk, Senator,
Yeah.
that's correct.
Okay. So substantially all significant risks were taken by Rentec. Now, you then made a report, you being Barclays, made a report annually to the SEC, and if you'll take a look at Exhibit 68, you'll see those reports for the past 5 years. And in that report, you state that Barclays does not control Palomino. Are you familiar? Were you here this morning when we went through these?
Senator, I heard the discussion this morning,
All
and
right,
it,
take a look at Exhibit 68, if you would. Starting with page 230, this was the, this was a note to the account filed with SEC for the year ending December 31st, 2009. And what you told the SEC, if you look at the end of the first paragraph in note 41, that these entities, you're referring to the Cayman Islands Incorporated Palomino, is one of the two entities you're referring to, are not deemed to be controlled by Barclays. Was that true when you told that to the SEC?
yes, Senator, for accounting purposes, that's 100% true.
And did you tell the SEC that you really don't mean it for other purposes?
Senator, I don't know what specifically was said to the SEC.
But
It
was-
doesn't surprise me that these regulatory filings are consistent with the correspondence that we laid out in PwC, and that shouldn't surprise us, Senator.
Doesn't surprise me at all. What surprises me is that you're waffling on the question of whether or not Palomino was controlled by Barclays. You represented it wasn't.
Senator, I'm not waffling on the question, Senator.
Well, you are waffling because you're saying for some purposes it was controlled, for other purposes, control means something totally different. If that's not a waffle, I don't know what is.
Senator, we own the entity. We consolidate. The results are reflected in our annual report in the footnotes. We comprised the board. We had risk. We shared in some revenues, Senator.
I'm talking about what you represented to a regulator at the SEC.
Senator, this representation to the SEC says that Barclays did not have control of the trading activities.
No, it doesn't. It says the entities, you're talking about Palomino, is managed by external counterparties and consequently are not controlled by you guys. You didn't say for trading activities. You just say they're not controlled. You didn't qualify it here.
Senator, I'll agree with you, Senator. That's what this says.
You'll agree with me that I read it correctly.
Correct, Senator.
And you'll agree with me that it doesn't say, it wasn't limiting what was meant by or not controlled.
Agree there is no qualifying in this report,
So that's
Senator.
progress. That's year after year after year, right? I won't go through them all, but Exhibit 58, the same words essentially for 2010, 2011, 2012, 2013. There's a slight modification in the words, but it's essentially the same. So now let me go to yeah, in your statement, you indicate that the question of the proper tax rate to apply to the profits earned through Barclays basket transaction is, quote, a matter to be handled between Renaissance as a taxpayer and the IRS. But now I would refer you to Exhibit 38. This is a Barclays document, 2002, August 22nd. About third paragraph, it says, Colt, and that's what we're talking about here today, is targeted at those funds with a high proportion of U.S. individual investors, stable year-on-year returns, and strategies involving short-term trading. This gives rise to significant short-term capital gains for the investors, regardless of whether or not they are invested in the fund for the shorter or longer term. Then come the key words. Colt provides an after-tax benefit to these investors through the conversion of their return from the fund from short-term capital gains taxed at 39.6 to long-term capital gains taxed at 20%. So this is what you are selling to Renaissance. This is what is in your project. Now, do you have any responsibility at all, do you think, to your clients in terms of representing that there are certain magic ways of converting short-term into long-term? Don't you think that you have a responsibility to determine whether or not you are aiding and abetting a fiction?
Senator, I wouldn't characterize this as fiction.
Well, if it were a fiction, do you think that you should be responsible for avoiding it?
Senator, I wouldn't characterize this as a fiction. We have a responsibility to our clients to assist them with transactions and ideally to do them in a tax-efficient way.
Tax efficient, what does that mean?
Senator, we don't have clients who call up investment banks and tell us we'd like to do a transaction and we'd like to pay the maximum amount possible.
Of course, I would hope not.
The phone would never ring, Senator.
I agree. So now you are targeting funds like Rentec. That's the target here. And you're saying that one of the major benefits is that you can convert, to use your words, short-term gains, which are taxed at 39%, to long-term gains, which are taxed at 20%. You're holding that out as an advantage. Is that correct?
Senator, we did not target Renaissance. They approached us with the structure. This is an internal approvals process, right, where we're being very transparent to all the decision makers about the tax elements of the transaction, Senator.
But you, in your own words here, you are saying that Renaissance, who's, I believe, was the only user, or the only basket option that this was aimed at. Is that correct? that Palomino was aimed at?
Senator,
That was aimed at Renaissance. Is that correct?
Senator, this correspondence says we would target funds, but we only executed the transaction with Renaissance.
Okay. And you say that it provides the benefit of converting something. And are you saying that that was never mentioned to Renaissance?
Senator, I don't cover the account, Senator. I'm not aware of the dialogue. I believe both parties understood the tax benefits associated with these barrier options.
But it was targeted at funds that were involved in short-term trading. Is that correct? By your own document. It was targeted at those funds that involve short-term trading strategies.
Senator, I wouldn't know if...
That's your own words.
Senator, the product, this is an internal approvals correspondence.
Does that make it less
No,
or
it
more
doesn't.
accurate?
It doesn't, Senator.
Was it accurate or not?
Let me respond, Senator. You asked me if we in fact targeted funds, right?
Right.
My response was, I don't know, okay? We only executed with Renaissance. This suggested, okay, that if approved, we would target additional funds. Whether we in fact put this product in front of other clients, I don't know, Senator. I'm not a salesperson. I don't in fact know the answer to that question.
Was this targeted at funds such as Renaissance?
The structure was brought to us by Renaissance, Senator.
Is Colt targeted at funds such as Renaissance?
Not to my knowledge, Senator.
Okay. Then I'm reading from your document. Colt is targeted at those funds with a high proportion of U.S. individual investors and strategies involving short-term trading. You're saying that was not targeted at Rentec?
Senator, I have said that Rentec
I understand.
brought the
Rentec
structure
brought
to
it to your
us.
attention. But I'm asking, was the structure which resulted after they came to you asking you to design a structure, that structure which you then offered to them, I'm asking you, was that structure targeted at those funds? I'm reading your Barclays document.
Senator, was targeted at Rentec.
That's what I'm saying. And those funds involve short-term trading, have a strategy involving short-term trading, and this provides an after-tax benefit to magically convert short-term to long-term gains. But the point is, this structure that you created after Rentec asked you to offer them a structure, this was targeted at Rentec, and you were aware of the fact that it would provide an after-tax benefit, like I described.
Yes, Senator, that's
All right.
absolutely correct. I
Good.
was confused and thought you were asking if we had targeted other funds other than Rentec.
All right.
And I'm not aware of that.
Now, in November of 2010, the IRS issued a generic legal advice memorandum, a GLAM, advising that basket option transactions similar to what Barclays was using should not be treated as an option for tax purposes. That same day, an employee of Barclays sent an email to his colleagues recognizing that GLAM was describing the Barclays basket transaction. That did not stop you, Barclays, from continuing with the transaction. Over the next 2 years, from late 2010 to late 2012, Barclays entered into another 9 basket option transactions with Renaissance. Renaissance gained about $4 billion from 6 of those transactions, and 3 are still ongoing. Now, in light of the GLAM, this seems to be a pretty aggressive position that Barclays took. And why is it that you dismissed the position that the IRS put out in the GLAM and continued to proceed with so many of those transactions?
Senator, we took the GLAM very seriously. At the time of the receipt of GLAM, we again consulted with our external advisors as well as our internal experts, and felt that the GLAM wasn't the law. It was an IRS view and perspective. We consulted with our accountants, In fact, I would point out in a paper we submitted to the committee, there's a document from PwC which is skeptical of the IRS analysis and conclusions, Senator. We continue to monitor for IRS bulletins, but we made a decision at that time that the transaction was appropriate and that we would continue.
Okay, now that IRS glam says the following about hedge fund basket option contracts. This memorandum addresses certain contracts styled as options in form but acting like direct ownership of the underlying property in substance. This memorandum should not be used or cited as precedent. And here's what it says, its conclusion, which I think I assume you take IRS conclusions seriously. Do you?
Absolutely, Senator.
Here's the conclusions. This contract, excuse me, well, let me read you what the issue is, because it fits like a glove to what these banks were doing, your two banks were doing. Where a taxpayer, a partnership, entered into a contract styled as an option to purchase a basket of securities that the taxpayer's general partner also actively managed and controlled while the contract remained open, and with respect to which the taxpayer had opportunity for full gain and income and substantially all risk of loss. One, whether the contract should be treated as an option for tax purposes, and two, whether the taxpayer should be treated as the tax owner of the securities. Now, that is about as accurate a description of what was going on here as I can read. We tried very often to describe this in our report and in my opening statement, and I can't do much better. Here's the conclusion. One, the contract does not function like an option and should not be treated as such. Two, a contract that provides a taxpayer with dominion and control over a basket of securities, the opportunity for full gain and income, and substantially all of the risk of loss, provides to the taxpayer beneficial ownership of the securities for tax purposes. Were you aware of this?
Yes, Senator, I was.
All right, now, I would hope that that would be taken seriously, but here's what happened. For 2 years, you continued to sell these basket options. And then in July of 2012, following a number of investigations into Barclays' business practices and its participation in tax avoidance structures, Barclays undertook an independent review known as the Sulls Review, and the objective was to review Barclays' business practices. The review was critical of the bank's culture, describing it as winning at all costs, and finding that it took, quote, robust position with regulators and followed the letter rather than the spirit of the rules. Were you in attendance at a meeting in October of 2012, Mr. LaRocca, in which Barclays decided to approve another Colt transaction?
Yes, I was, Senator.
If you take a look, please, at Exhibit 61. This is the minutes of the Structured Capital Markets Approval Committee, Barclays. The topic of the meeting was consideration of a new Colt transaction. Some of the key points that were made during the discussion that led to the approval of a new Colt option This is now October 2012, after the Saul's review was undertaken. And this is what the notes, key points of the discussion were according to the notes. And the option was recommended for approval, again, the same basket option. Why? The tax risk is assumed by the client. Right off the bat, tax risk is assumed by the client. There's a reputation risk for Barclays, especially if the matter proceeds to court. The new option transaction does not meaningfully increase Barclays' reputation risk in relation to the option transactions, because writing a new option or exercising an existing one should be viewed as the maintenance of a long-standing structure. Now, you were the chairman of this meeting, Mr. LaRocca. You knew about the GLAM. You knew there was reputational risk. You knew that Salt's review had started and was reviewing the business practice because Barclays had been subject of tax investigations, but you still recommended that the transaction be approved. You were then and now are the most senior executive in the United States, Barclays. At a minimum, shouldn't you have been concerned about the reputational risk to the bank? Approving the same option after a GLAM had been issued on this, the IRS couldn't be clearer in the GLAM. At any rate, you decided we're going to approve it anyway. Shouldn't you have been more concerned about the reputational risk to your bank at that time?
Senator, I was very concerned about the reputational risk of the
And
bank.
should you have recommended continuing on that course?
Senator, if looking at the same document, you'll see the actions I took as chairman. Again, we look for reaffirmation of our legal opinions and our external advisors. We spent a considerable amount of time. I escalated this issue to members of our executive committee, Senator. I also recommended that this transaction be reviewed by our reputational risk committee. I was very much aware that the Saul's review was underway, and we concluded, Senator, at this point in time, that we should continue the options.
I know you concluded it.
Yeah.
But basically, the IRS had spoken, and Barclays said, so what? Now, that's what we call an aggressive tax position. And it was taken after all of these events which we've described had occurred, when the IRS in a GLAM just describes, it's precisely what you guys were doing, and says, as it did, that, hey, this is not an option, and this is not going to be recognized as long-term capital gains for tax purposes. You still, your committee, you're the chairman, still recommended that you go ahead with another one. Why? Because, hey, you're already at risk. What's a little more risk? I mean, just the fact that something's been used repeatedly and then challenged by the IRS, what kind of argument is it that, well, hey, we've done it before, we'll continue doing it? That's not a good argument in terms of reducing reputational risk. Quite the opposite, it seems to me.
Senator, the IRS hasn't yet made a decision on what the appropriate tax treatment is. When we've consulted with our external experts, legal, tax, accounting, they raised serious questions about regarding the analysis that underpins the GLAM.
The IRS describes GLAMs as, quote, providing authoritative legal opinions on certain matters such as industry-wide issues.
Senator, I hope the GLAM...
I don't think you take it very seriously. I got to tell you, if you're really worried about reputation, given all the problems that Barclay has, and given the fact you got a GLAM from the IRS, and it's right on point describing exactly what you're doing, and it says, hey, this is not an option. It would seem to me caution. If you're worried about your reputation, you say, whoa, let's hold off on this thing, folks. That's what caution does. That's what concern about reputation does. It's not, hey, we've been doing this for years. So what? We'll continue to do it in the face of a glam? I don't consider that to be concern about a bank's reputation. Barclays then in 2013 initiated a bank-wide effort called Project Transform to ensure that the bank no longer offered or participated in abusive tax shelter products. Barclays counsel informed the subcommittee that as a result of Project Transform, Barclays developed a number of principles, including in the tax area. One of these principles is that Barclays won't engage in transactions that won't meet expectations of the relevant tax authority. At that point, you revised this option to make sure it could not be used for to argue that the gains are long-term capital gains. You changed that in 2013 after another project of yours adopted a principle saying, don't engage in transactions that wouldn't meet expectations of the relevant tax authority. If you had adopted that earlier, you would not have issued those later options. Is that correct?
That's correct, Senator.
Okay. Now, you've got some existing basket transactions, do you not?
Yes, we do, Senator.
There's 3 of them, I believe. And they don't conform with the new policy, and the contract with Renaissance allows for the unwinding of those contracts. Why not unwind them? Under the policy you've adopted a policy, as a result of Project Transform, new principles. We're not going to engage in transactions that won't meet the expectations of the relevant tax authority, but apparently you're going to continue to participate in transactions that don't meet that expectation because you haven't unwound those 3 existing basket options. Why not unwind them?
Senator, we've made a decision to not enter into any new transactions, Senator.
I understand, but why not unwind existing transactions because they don't meet the expectations of the relevant tax authority? Why not unwind them? You're allowed to, under the contract.
Senator, we're allowed to unwind them, and we haven't looked at the historical transactions that we approved prior. So the decision that
How about maybe you ought to? What do you think?
we'll take it under advisement, Senator.
Thank you. Barclays. Thank you. Who does? Who has to leave? Let's see, Mr. Bassano. You've testified that Deutsche Bank engaged in a major restructuring of its MAPS product. That's this basket option transaction, and you engaged in a major restructuring in 2008. This ties in with what we had heard, our staff had heard from Mr. Haas, who's the global head of Deutsche Bank's prime brokerage division, and from your counsel who represented the staff, that Deutsche Bank had concerns whether the old structure would be respected as an option for tax purposes. So in 2008, Deutsche Bank undertook an effort to make maps look more option-like. I believe your Global Prime Finance Division described the MAPS restructuring project as an effort to, quote, provide a new multiple map structure that will more closely resemble a traditional options structure. Now, I want to just explore one example of that concern that you had that caused you to engage in that restructuring. Before the restructuring, Deutsche Bank paid Renaissance a flat advisory fee, which was well below an industry standard fees for an investment advisor. So did you make the change in the fee structure to make this transaction look more option-like?
We restructured.
Pardon?
We restructured the option on the basis of two parallel tracks. The first, as was described by Mr. Ramakrishna, was a concern about the risk profile and the higher risk associated with gaps in the cluster of statistical arbitrage strategies, as evidenced in the summer of 2007, August of 2007. The second parallel push was a combination of concerns in the evolving regulatory landscape as communicated to me through my internal control functions, legal, tax, compliance, et cetera. Our view is that this has a significant number of option features and is clearly an option. The idea that you have a asymmetric payout where your risk is limited to the premium you've paid, you have a upside convexity to leverage and performance if you succeed, is to me the key hallmarks. It's a contract with a duration and an expiry, are all things that are hallmarks of an option.
Did you offer the increase to Renaissance without being prompted by them?
I was not part of those negotiations.
Do you know whether or not Deutsche Bank?
I do not know which side proposed that.
Well, then let me ask you the question again. Was the shift, the change in the fee done in part in order to make the transaction look more option-like?
I do not know what the negotiation went on. I was not part of it.
No, I'm not asking about what the negotiation. I'm asking you whether the change in the fee from a flat fee was done in part to make the transaction look more option-like. That's what I'm asking.
I really don't think so. I think it reflected what the standard investment advisory agreement to a fund would have been.
Okay. Prior to the 2008 restructuring, did Deutsche Bank have any indications that the old MAP structure would not be respected as an option? Prior, you want me to repeat the question?
No, I heard before 2008.
Before the restructuring.
Before the restructuring. Not to my knowledge.
You had no indications that the old MAP structure would not be respected as an option?
No, as a matter of fact, to this date, no court or regulator or statute has disqualified as an option, either old or new.
That's not what I'm asking, whether a court or regulator asked. I'm asking you, was there an indication from any source that the old MAP structure would not be respected? You answered it. We didn't hear from a regulator or court. That's not my question.
Yeah, to my knowledge, no. However, I'm aware that my control functions were in regular conversations with all of the external regulatory constituencies on an ongoing basis.
How about internally?
Internally, we discussed.
Was there any evidence internally, any discussion internally to that effect?
That it would not be respected, not to my knowledge.
Was that question ever referred by you to a law firm for an opinion on it?
I'm sorry, repeat again?
Was that issue ever referred to a law firm to give you an opinion on that question?
I am aware we had a should-level opinion on that.
The, pardon? Was that before or after the restructuring?
I don't have a specific date, but I know it was early in the life cycle of the trade.
Was it, do you know whether it was before or after the restructuring?
I don't know.
Deutsche Bank entered into a non-prosecution agreement with the Department of Justice stemming from its involvement with abusive tax structures, and under the non-prosecution agreement, Deutsche Bank promised to stop participating in and implementing fraudulent tax shelters and agreed to bring to the attention of the Department of Justice, quote, products or transactions that may run afoul of U.S. federal income tax laws, rules, and regulations. Now, Mr. Bassano, in your written testimony, you said that, quote, it bears noting that the bank discussed the MAPS product with the Department of Justice, the IRS, the SEC, and the independent expert Deutsche Bank retained as part of the NPA. All of the discussions took place well before this committee began its investigation. Indeed, the bank communicated with the independent expert about MAPS at a meeting on February 3rd, 2011, and discussed the MAPS product with the Department of Justice and the IRS at several meetings in 2012 and 2013. You stated in your testimony that Deutsche Bank discussed this matter with the SEC. My question to you is, weren't those discussions initiated by the SEC as part of an SEC examination of MAPS?
I was not part of that conversation. My secondhand knowledge is as part of a examination, but that's arm's length.
Arm's length or secondhand?
Secondhand.
So, secondhand, you say you heard that this discussion with the SEC came as part of an SEC examination. Is that correct? That's what you've heard secondhand?
As part of my preparation for this conversation, that I was made aware of that.
Okay. Are you aware of the fact that the SEC referred Deutsche Bank's activities to the IRS because the basket option strategy was being used to turn short-term capital gains in the portfolio into long-term capital gains, and the options were being exercised after 1 year, thus subjecting the returns to long-term capital gains tax? Were you aware of the fact that because of that claim that there was a long-term capital gain, that the SEC referred this activity to the IRS? Were you aware of that?
I was made aware of it as part of my preparation.
The first time that Deutsche Bank communicated the MAPS program to the Department of Justice was in 2012. Deutsche Bank didn't disclose its MAPS program to the Department of Justice when it was negotiating the non-prosecution agreement in 2010. Is that correct?
I was not a part of that negotiation. I learned about the NPA upon its settlement.
Okay. Were you aware of the fact, however, that Deutsche Bank did not disclose this MAPS program to the Department of Justice when it was negotiating the non-prosecution agreement in 2010, even though you weren't part of it? Were you aware of that?
As part of my preparation, I've heard that. I have no knowledge.
No personal knowledge, but you were informed of that? As part of your preparation, that's what you were informed?
That prior to the, could you repeat what I'm?
I will. Were you informed that the first time Deutsche Bank communicated the MAPS program to the Department of Justice was in 2012, and that it did not disclose the MAPS program to the Department of Justice when Deutsche Bank was negotiating the non-prosecution agreement with the Department of Justice in 2010?
I'm not specific on the date of the conversation with the DOJ. I am aware that the judgment of the negotiators in the NPA was that it was not shared at that time.
Okay. Are you aware that Deutsche Bank went to the Department of Justice with the MAPS matter, disclosed it to the Department of Justice only after the Federal Reserve Bank of New York, which had been examining MAPS, expressed concerns and instructed the bank to go to the Department of Justice?
My understanding is that the independent expert that was in Deutsche Bank at the behest of the DOJ was informed of MAPS, and it was our presupposition that as the direct conduit to the DOJ that would have been passed through. When we learned that wasn't the case, we informed them directly.
And then when you informed them directly, was that after the Federal Reserve Bank, which had been examining maps, expressed concerns and instructed the bank to go to the Department of Justice?
I'm not aware of the specifics of that.
Okay. Was there any concern within Deutsche Bank that to continue with the new maps after signing the non-prosecution agreement might put the bank in violation if it continued with that transaction?
With the new maps?
Yes. Was there any concern within Deutsche Bank that to continue with the new maps after signing the NPA would be a violation? Or could be a violation?
Well, we had moved to a less than 1 year only posture by that point, I believe.
Okay. Now, when Deutsche Bank put a temporary halt to MAPS transactions in late 2010, it still had 3 basket transactions outstanding in 2011. They all lasted a year or more after the GLAM. Why didn't Deutsche Bank cancel those, unwind those? As I just asked Mr. LaRocca, you had the right to do so under the basket contracts. Why not do it?
We felt that an abundance of caution to cease the product was appropriate and was what we did. The ones that were extending, we felt that they were at that point and continue to be legal, legitimate transactions, and elected to honor the terms of those transactions to their conclusion while not pursuing any further.
No, I understand that, but you decided not to continue to issue these contracts because of various concerns which you had. Why not unwind the contracts which you had since you were allowed to do that? Under the contract, you could have unwound these. These were obviously finally of concern to you. It took a whole lot of years to get there, but nonetheless, you finally reached that point. So why not do what you were allowed to do under the contract, and that is to unwind contracts which are problematical? And your answer is that you didn't. But why didn't you? Did you think about it? Did you consider it?
It was the business judgment that we were being sufficiently aware of and respectful of the guidance we had gotten both from a legal, regulatory, and guidance perspective by ceasing to go on, and that the balance of risks was we would be better served to keep the contract as we had originally negotiated it with the existing clients. So we were aware of it, and we thought we were being especially and deliberately respectful of the changing regulatory landscape already.
I think you may have been wrong in terms of the new maps as it related chronologically to the NPA.
Okay.
The NPA was 2010. And I think you said that you had no concern there about whether the new maps would be compliant with the NPA. But wasn't the NPA in existence before the new maps was put in existence?
I don't believe that's correct. I have a chronology that's been submitted to you.
Let me correct it. Yeah. I got it. Okay, let me rephrase it because it was inaccurate, my phrasing. You moved to a 11-month term in 2012, I believe, to make sure that the option when exercised could not be claimed to be a long-term capital gain. Is that correct? That was 2012, I believe.
I have April 2012 as the first new maps, shorter dated.
But the NPA was in existence in 2010,
Right, new maps was struck in 2008.
in 2008. But your short options, your 11-month option wasn't put in place till 2012. And so the question is, were you concerned after the NPA about that issue? And if so, why didn't you change to the short option, the 11-month option, before 2012? Why did it take you so long?
The new map structure was fully. Ready? Sorry.
I'm ready, sure.
We were fully advised internally by our control functions of legal, credit, tax, compliance, and external advisors at the time that it was a compliant and well within the boundaries and well within the area of ambiguity, and therefore thought it was safe to proceed.
All right, so in other words, okay, I think we move on from there. Let me ask you some questions, Mr. Brown. In your statement, you say that the reference portfolio for each option was generated by Renaissance's trading algorithm, and you make it sound like the selections were made by a machine with no human intervention. Now, your scientists and your experts are continually looking for inefficiencies in the market, and when they find something new, as I understand you and your testimony, they try to adjust the computer model and incorporate that into the algorithm. That will affect the decisions that are generated, could also have an impact on what positions are bought and sold. So there's a lot of ongoing human involvement in this process. Is that correct?
That is correct.
And how many employees are there at Rentec?
I think roughly 300.
And of these employees, how many work part-time or full-time on the algorithm strategy that supports Rentec's, or supported Rentec's basket option transaction?
Well, in the strategy, 50 or so.
And these would be employees with backgrounds in mathematics, physics, and computer science?
That's correct.
The employees that worked on the overall strategy to identify market inefficiencies in order to take advantage of them, I assume did this on an ongoing basis. Is that correct?
Yes.
And how frequently were they identifying these inefficiencies and modifying the inputs that go into the overall strategy? Was that a frequent occasion?
Well, most of the modifications involved maintenance changes to the system has 1 million lines of computer code, and when you have 1 million lines of computer code, it has to be maintained. Interfaces change. I don't know if you're counting those kinds of changes.
No, just when you tweak the algorithm.
Yeah. And so I'm sorry, what was the question? How many people work
No,
on?
how frequently
Oh,
were you doing that? Was that a daily change?
no.
Weekly, monthly?
No, more like weekly.
Okay, so every week there would be roughly
1 or 2 changes roughly on average.
in the algorithm.
Yeah, the algorithm has been developed over 25 years. It probably has 1,000 man-years of work into it. It's very mature at this point. It's very hard to make significant improvements, so these are minor changes typically.
But there's you got 50 people working on this. There's a lot of human involvement in Rentec in this.
Oh, that's not all they do. We trade commodities, futures.
I know that, but I specifically ask you the question on this particular, for this particular process, this basket option process, how many were working full-time or part-time on the strategy that supported Rentec's basket option
Yeah,
transactions?
I think my answer is accurate.
Okay, so we'll stick with 50. That's fine.
I mean, roughly, I don't know
That's fine.
exactly. Okay.
About 50. That's a lot of people. A lot of human intervention, wouldn't you agree? 50 people working on these basket options? Okay, I'll let it speak for itself. You don't have to agree with it.
Okay.
It's a lot of expertise. Now, did Rentec personnel intervene in the strategy to respond to market events?
Well,
You know, like during the Greek crisis.
oh, sure.
Rentec
Well, when you say
shift
the
billions of-
strategy, what happened, I can know about the Greek crisis, for example, if you like. What happened there is that we were concerned at that time that Barclays had a lot of exposure to Greece.
And so you could shift billions of dollars of its portfolio, for instance, from
No,
Barclays?
that's not what happened.
Well, could you?
Could
Did
we
you
have?
shift- Did you shift any money from Barclays to Deutsche Bank?
Shift money? No.
Okay. Did you direct more of the sales orders to one bank and more to the purchase orders to to the other bank?
Yes, we made a change to the process that distributes portfolio amongst the options. So the algorithm produces a bunch of trades and produces a portfolio, and more or less of it can go to different options. So prospectively, going forward, we made a change so that it would tend to put more portfolio with Deutsche Bank and less with Barclays.
And that was some of the type of work that your 50
That's correct.
experts would do. And so, with the human intervention in this process, this affects what positions are bought, sold, and how long they're held. Is that correct?
Yes, as I said, the changes are modest, but yes.
Who changes their mind? Human beings?
Who changes their mind?
What did you just say? Change
These
your
are
mind?
modest,
Your models.
small.
You make changes in the models.
That, yes, they're modest changes in the models.
Modest changes in the models by these human beings.
That's correct.
This algorithm wasn't just making changes by itself. It took human beings to make changes.
Yeah, sure. The human beings wrote the code.
Good. And changed the code.
That's correct.
Tweaked the code. And once or twice every week, changed.
On average,
On
yes.
average. Okay. When you made these changes in the algorithm, did you consult with the banks?
No.
Is the algorithm Rentec's proprietary strategy?
It is.
Do the banks ever change the algorithm?
No.
Now, you got about 300,000 transactions executed in the banks per day for Rentec's basket contracts. Were these submitted in the form of recommendations or suggestions to the banks?
Well,
Assuming they met the guidelines, of course, which you had already agreed upon. But were these submitted, 300,000 approximately, transactions in the banks
So-
each day for the basket contracts? Were they submitted in the form of recommendations or suggestions, but were they automatically sent to the market, providing they met the guidelines which you had agreed to?
So they were sent to, most commonly sent to the bank's trading systems.
All right.
And if they, sometimes they were rejected, not very often, and otherwise they went to the market. That's correct.
And not very often would be if they didn't meet the guidelines?
I think that's the only ones I know of where, the restricted list had been changed and we weren't aware of it, that kind of thing. Those are the ones I know of.
All right, so there was an agreement, there were guidelines, a restricted list, whatever you want to call it. If it didn't meet that, then it wouldn't go to market.
That's my understanding, yes.
And that didn't happen very often.
No, it did not.
How many times?
I don't know how many times.
Oh, how many times in a year?
A few.
A few in a year.
I would guess, I'm not,
I know, you're-
I'm guessing there.
Best of your ability, you're guessing a few times a year.
Yeah, I mean, if it's 20, it wouldn't surprise me. If it's 3, it wouldn't surprise me in that range.
That's out of 30 million a year.
I haven't done the multiplication, but that's probably correct.
That's not multiplication, that's a question of fact.
Well, I don't know if it's 30 million or 35 million or 40 million. It's millions, many millions.
Tens of millions.
Yes,
It could have been 3 or 5 or 10 times it didn't meet the guidelines.
that's correct.
I'm going to conclude, we've got a vote on here now, so let me just end with a few remarks here. Situation that we've looked at here over a year or more is where an armada of law firms and hedge funds and financial institutions have devised financial structures that in substance are far from what they pretend to be. A series of fictions is created to create one big fiction, and that's to gain advantages which otherwise could not be obtained. Now, the structure the subcommittees explored today is an example of what we've been doing for many, many years, looking at these structured transactions just to see how tax avoidance works in this country. The companies that engaged in the basket options and the law firms that support them ignore the realities of the transactions that they're engaged in by employing a structure that seeks to portray the activities as something from what they really are. And they hope that those that are reviewing the transactions won't catch it. Now, those who complain about the complexity of the tax code should look at these examples of tax avoidance and tax abuse and realize that it's this kind of gamesmanship that drives the complexity in the tax code, because the IRS is always trying to catch up and clarify that the fictions that are concocted are not in compliance with the law. And if the parties that use these fictions and these structures want the tax system to be more straightforward and clear, they should end the gamesmanship. That's the issue that underlies what the subcommittee has been addressing. I hope the regulators and federal agencies will take note and try to address the larger issue that has been posed here. And I hope members of the financial and the legal communities will do that as well. The structures that we've examined today have real consequences because they offload billions of dollars in taxes that are shrugged off by hedge funds onto the backs of ordinary American taxpayers. They add billions of dollars in leverage to the U.S. financial system. It doesn't have to be this way. The IRS can audit hedge funds and collect taxes that weren't paid. The SEC can stop basket options from being used to circumvent leverage limits. The Financial Stability Oversight Board, working with other agencies, can impose new reporting obligations to detect and stop hidden leverage through derivatives. Congress can amend TEFRA to remove obstacles to IRS audits of large partnerships like hedge funds. Congress could go further and adopt the proposal of my colleague from Michigan, Congressman Camp, and tax all derivatives at the end of the year on their market value. That would short-circuit a lot of the games. Option baskets are being misused and abused to dodge taxes and to circumvent leverage limits. And we're going to continue, as long as I'm here, to do everything I can to stop these abuses. We end the hearing with thanks to our witnesses for their cooperation with our subcommittee, and we stand adjourned.